In the world of investing, the concept of risk and return is a fundamental principle. Generally, the higher the risk, the higher the potential return. This idea is based on the premise that investors demand greater rewards for taking on greater uncertainty. The reasoning is simple. If you're willing to put your money into something that could lose value or be highly unpredictable, you should be compensated for that risk with a better return. However, this theory does not always hold true in the real world. There are instances when safer, lower-risk investments outperform riskier ones over extended periods. This paradox challenges the common assumption that risk and return are directly correlated. To better understand this phenomenon, let's examine some examples where safer assets have outperformed riskier ones and explore why this happens. One of the most well-known and often cited examples is the long-term performance of U.S. Treasury bonds compared to stocks. U.S. Treasury bonds, considered one of the safest investments, have historically outperformed stocks over certain periods. For instance, over the past few decades, investors in U.S. Treasury bonds have enjoyed consistent returns, while stock markets have experienced volatility with some extended periods of poor performance. The stock market's higher risk did not always translate into higher returns. A major reason for this paradox is market cycles. While stocks can provide higher returns in the long run, they also go through periods of significant downturns. During economic recessions or times of financial instability, stocks can drop in value sharply, even losing half or more of their worth. On the other hand, bonds, particularly government bonds, tend to be more stable. During these times of market volatility, investors often flock to bonds as a safe haven, driving their prices up and offering strong returns. This cycle can create periods where bonds outperform stocks, even if stocks have greater potential for returns when times are good. Another example can be seen when comparing large-cap stocks to small-cap stocks. Small-cap stocks generally have greater growth potential due to their smaller size and the ability to grow rapidly. However, they also come with greater risks. Despite this higher potential, large-cap stocks, which are typically more stable and well-established companies, often provide more consistent returns over time. In periods of economic uncertainty, large-cap stocks tend to perform better because they have more financial stability and better access to resources. The performance of safer investments like bonds or large-cap stocks can also be enhanced by macroeconomic factors. For example, during periods of low interest rates, the yields on bonds may be lower, but the demand for bonds can increase as investors look for safer assets with guaranteed returns. Additionally, low interest rates often coincide with periods of market instability, where investors flee to safer assets. This means that the riskier assets, like stocks, may not be able to deliver the kind of returns investors expect, while the safer bonds still provide steady returns. One of the most notable periods where safer assets outperformed riskier ones was the aftermath of the 2008 financial crisis. Following the crash, stock markets took a long time to recover, with many investors losing significant amounts of money. In contrast, government bonds, especially those issued by stable countries like the US, delivered consistent returns. This paradox can be explained by the fact that during times of financial crisis, investors tend to become risk-averse, and safer assets become more attractive. Thus, riskier assets like stocks do not always offer higher returns, especially when the market is in a downturn. Another contributing factor to the risk-return paradox is the behavior of individual investors. Many people are drawn to the potential for high returns offered by riskier investments, like stocks or startup companies, but they often fail to account for the risks involved. This can lead to a situation where, despite the higher risk of these investments, they may not always provide the higher returns expected, especially when considering the impact of market timing, investor behavior, or the timing of economic cycles. The safer assets, on the other hand, tend to offer more predictable returns, even though their upside potential is more limited. It's also important to recognize that the concept of risk itself is not always straightforward. What constitutes risk to one investor may not be the same for another. For instance, an investor who has a long-term horizon and is not concerned with short-term fluctuations may view stock market volatility as a normal part of the investing process and be willing to accept the risk of occasional losses. On the other hand, someone closer to retirement may view those same fluctuations as a significant risk to their financial well-being and prefer the stability of bonds or dividend-paying stocks. There is also the factor of diversification. One of the main strategies to manage risk is through diversification. By spreading investments across different asset classes, industries, and geographic locations, investors can mitigate the risk of large losses. Diversified portfolios tend to perform better over time because they reduce exposure to the volatility of any single asset class. While an individual risky asset might perform poorly in the short term, a diversified portfolio may not experience the same degree of volatility, potentially leading to better long-term returns. In addition, the concept of volatility is crucial in understanding the risk-return paradox. High volatility, while often associated with high returns, can also be detrimental to long-term wealth accumulation. For instance, during volatile market periods, investors might make emotional decisions, such as selling stocks when the market is low and buying them back when prices rise. These kinds of actions can erode returns and lead to worse outcomes than if they had invested in safer assets. Even if riskier assets offer higher potential returns, volatility can discourage investors from holding onto those assets for the long term, resulting in lower actual returns. In conclusion, while the traditional theory of risk and return suggests that higher risk leads to higher returns, real-world examples often defy this assumption. Safer, more stable investments can outperform riskier ones during times of economic uncertainty or market instability. The key takeaway is that the relationship between risk and return is not always linear, and investors must carefully consider their own risk tolerance, time horizon, and the current economic environment before making investment decisions. More stable investments can outperform times of economic uncertainty.
If a God is all-powerful, all-knowing, and all-good, why does suffering exist? This is the core of the Omnibenevolence Conflict. It's not new. Philosophers and theologians have wrestled with it for centuries. The problem is simple on the surface, but complex once you look closer. It challenges how people define goodness, power, and purpose. It questions the nature of belief itself. Omnibenevolence means perfect goodness. An omnibenevolent God wants only what is good. This God would not allow unnecessary pain or evil. Combine that with omniscience, the ability to know everything, and omnipotence, the power to do anything, and the expectation is clear. Evil should not exist. But evil does exist. Children get cancer. Wars destroy families. People suffer from famine, disease, and cruelty. The world contains real, undeserved pain. If a God exists and holds all three traits, something doesn't add up. A classic way to frame this is with three statements. 1. God is all-powerful. 2. God is all-good. 3. Evil exists. You can hold any two of those easily, but all three together create tension. If God is all-good and all-powerful, then why would evil exist? If God wants to stop it and can stop it, why hasn't he? Some try to resolve this with free will. They argue that humans must be free to choose. If people are free, they can choose evil. And with evil choices comes suffering. This view says that a world with free will is better than one without it, even if that means some will choose to do harm. In this framing, suffering is the cost of freedom, but this only covers moral evil, the harm caused by human choice. It doesn't explain natural disasters, birth defects, or pandemics. A tsunami doesn't arise from human will. A baby born with a fatal condition never made a choice. These forms of suffering seem unrelated to moral agency. To answer that, some propose a greater plan. They say all suffering serves a purpose we can't see. Maybe it builds character. Maybe it teaches compassion. Maybe it fits into a long-term good that we, with limited vision, cannot yet grasp. But this raises new questions. If an all-powerful God needs to hurt people to teach them, isn't that a limit on power? Couldn't such a God teach without pain? Or design a world where learning doesn't require loss? Why use suffering as a tool? Others invoke mystery. They say God's goodness is beyond human understanding. What looks like evil to us might not be evil in the grand scheme. But this answer can feel like an escape hatch. If anything can be called good just because it fits God's plan, then good loses its meaning. Morality becomes whatever God says it is. This leads to moral relativism under divine authority. It becomes impossible to challenge any act, no matter how cruel, because it could always be part of the plan. Now take the story of Job. In this ancient text, a righteous man suffers deeply. He loses his family, health, and wealth, not because he did wrong, but to test his faith. Job never learns why. God eventually speaks, but offers no direct answer, only a reminder of divine power. Some read this as a statement of humility. Humans can't understand divine reasoning. Others see it as an admission that suffering can be arbitrary, even under a just God. In the real world, this tension appears in every disaster. When a school collapses and kills innocent children, believers struggle to make sense of it. Some say it's a test, others say it's punishment, some say it's part of a bigger plan. Each answer tries to protect the idea that God is both good and powerful, but none feel complete. The grief remains. The logic feels strained. This conflict also plays out in theology. Some theologians adjust the definition of omnipotence. They say God can't do logical contradictions. He can't create a square circle, for example. Maybe he also can't create free creatures who never choose evil. This limits power, but in a way that preserves logic. Others adjust the idea of goodness. Maybe divine goodness is different from human goodness. But again, this weakens our ability to understand or evaluate what good even means. Another approach comes from process theology. This view says God is not omnipotent in the traditional sense. God works with the world rather than controlling it. He influences rather than commands. He suffers with us and tries to bring good from within the world's chaos. This redefines power. God becomes a co-sufferer, not a controller. But this solution requires letting go of the classic idea of an all-powerful deity. Some believers find this comforting, others find it unacceptable. Some say suffering brings people closer to each other and to God. They argue that shared pain builds solidarity, that grief softens pride, that loss reveals what matters most. This is the soul-making defense. It treats suffering as a furnace that shapes character, but it risks justifying terrible events as necessary. It can turn tragedy into utility, and that feels cold to many who endure it. Imagine a child locked in a basement and beaten. Now imagine someone watching it happen, able to stop it, but choosing not to. Most would call that person evil. Now apply that standard to a God who allows worse things on a global scale. The emotional reaction is powerful. People don't just question the logic, they question the morality. If God exists and watches children die of hunger when he could stop it, then how can he be called good? To avoid that charge, some strip God of power or knowledge. Others remove the goodness part. Some traditions say God is beyond good and evil entirely. He is the source, not the judge. But that again moves the problem. It removes the expectation, but also removes the comfort. If God is not good, why worship him? If he's not powerful, how can he help? If he's not aware, what makes him divine? This is where the conflict stays, circling unresolved. Believers respond in different ways. Some turn to mystery and trust. Others reject one attribute. God is good, but not all-powerful, or powerful but not good. Some reject God altogether. They say a world with this much suffering doesn't match a divine design. It reflects chaos, not control. They find comfort in honesty, not in hope. The Omnibenevolence conflict is not just a puzzle for scholars. It lives in hospitals, disaster zones, graveyards, and refugee camps. It appears every time someone asks, why did this happen? Or why didn't God stop it? The answers vary. The questions remain.
The concept of market efficiency has been a central idea in finance for decades. According to the efficient market hypothesis, EMH, financial markets are informationally efficient, meaning that asset prices fully reflect all available information at any given time. If this theory is true, then it suggests that it is impossible for investors to consistently outperform the market through strategies like stock picking or market timing. Essentially, if markets are truly efficient, there is no advantage in trying to beat the market because all relevant information is already embedded in asset prices. However, this leads to a paradox. While the EMH suggests that it's futile to try to beat the market, people still attempt to do so every day. And remarkably, their actions play a role in keeping the market efficient. This paradox is at the heart of financial markets. People who are trying to outperform the market by identifying mispriced assets or predicting market movements are, in effect, contributing to the very efficiency they are trying to outsmart. The first part of this paradox rests on the assumption that if markets are efficient, it should be nearly impossible for anyone to consistently achieve higher returns than the overall market, particularly after accounting for transaction costs. The EMH assumes that all publicly available information is quickly absorbed into asset prices. This means that if a company announces strong earnings, for example, the price of its stock should immediately adjust to reflect this news. As a result, there should be no opportunity for an investor to buy the stock before the price rises or sell it once the price peaks. In an efficient market, it would be incredibly difficult to find undervalued or overvalued stocks, because all the information needed to determine their true value is already reflected in the prices. But despite this theory, countless investors try to beat the market every day. Fund managers, individual investors, and even algorithms are all in pursuit of a return that exceeds the market average. They try to identify stocks that are underpriced, anticipate future trends, or time their trades to exploit small inefficiencies. These investors engage in activities such as technical analysis, fundamental analysis, or quantitative models to find investment opportunities that they believe are mispriced by the market. This quest for superior returns has one surprising consequence. It makes the market more efficient. When investors try to outsmart the market, they are constantly analyzing information and making decisions based on their perceptions of mispricing. If they find what they believe is an undervalued asset, they will buy it, which increases its demand and pushes its price closer to its true value. Similarly, when investors believe an asset is overvalued, they sell it, which drives its price down. As more investors take this approach, the market's prices adjust more quickly and accurately to reflect all available information, making it harder for anyone to consistently find opportunities for excess returns. This cycle creates a self-fulfilling prophecy. Investors trying to beat the market contribute to the efficiency of the market. The more investors there are trying to outperform the market, the quicker prices adjust to reflect new information. This dynamic helps ensure that no one is able to consistently achieve returns that beat the market on a risk-adjusted basis. As soon as a mispricing is detected and exploited, the opportunity disappears, and prices settle at a level that reflects the available information. The paradox becomes even more pronounced when considering the sheer number of people trying to outperform the market. In theory, if everyone were to adopt the efficient market hypothesis and simply invest in broad market indices, the market would reach perfect efficiency more quickly. However, the reality is that investors continue to believe in the possibility of outperforming the market. Even when faced with the evidence that most active managers struggle to beat the market over time, many still try to do so. This results in a constant cycle of buying and selling, driven by the belief that there are opportunities to exploit. In the end, these efforts create the very market efficiency that makes it so difficult to outperform the market. One of the key implications of this paradox is the difficulty of distinguishing between true inefficiencies in the market and simple fluctuations in asset prices. Many investors believe that by identifying these inefficiencies, whether it's a stock that has been undervalued by the market or an emerging trend, they can gain an edge. However, in an efficient market, what may seem like an inefficiency is often just a temporary fluctuation that reflects new information being absorbed into the market. As a result, investors may be chasing opportunities that don't exist or that quickly vanish once they are identified. The paradox also raises questions about the role of active versus passive investing. Passive investors, who invest in broad market indices rather than trying to pick individual stocks or time the market, rely on the belief that markets are efficient. They assume that by holding a diversified portfolio, they will receive returns that reflect the overall performance of the market, without the need for market timing or stock picking. Passive investing has gained popularity in recent years, especially as evidence mounts that actively managed funds often underperform passive index funds over the long term. However, the presence of active investors who are trying to outperform the market plays a crucial role in maintaining the efficiency of the market. By constantly analyzing and responding to new information, active investors help ensure that prices remain accurate. In a way, active investors are performing a valuable function, even if they are not consistently beating the market. Their collective actions ensure that the market remains competitive and efficient, as they help push prices toward their true value. Yet, despite the important role of active investors, the odds of consistently beating the market are slim. Studies have shown that, over long periods, most active managers fail to outperform a simple index fund. This is due to several factors, including high fees, transaction costs, and the difficulty of predicting market movements with any degree of accuracy. Even fund managers with access to sophisticated tools and research often struggle to deliver superior returns after accounting for costs. The result is that while people may try to beat the market, they often end up merely participating in a system that maintains its own efficiency. Diversification is one of the cornerstones of sound investment strategy. The basic idea behind it is simple. By spreading investments across different assets, industries, or geographic regions, you reduce the overall risk. The logic is that if one asset or sector performs poorly, others in the portfolio might perform better, thus balancing the overall risk. In theory, a diversified portfolio should protect an investor from the worst outcomes. Yet, there's a paradox that lies at the heart of this strategy. Diversification reduces risk until everything crashes together. To understand this paradox, it's helpful to start by looking at how diversification works in normal market conditions. Suppose you have a portfolio that includes a mix of stocks, bonds, real estate, and perhaps even some commodities like gold. If one sector, say stocks, takes a hit due to a market correction, the other sectors in your portfolio may not be affected in the same way. Bonds, for example, often perform well when stock markets are down, providing a cushion to your portfolio. Real estate and commodities might follow their own cycles, which could mean they don't move in the same direction as stocks or bonds at all times. This is the protective power of diversification. It spreads the risk across multiple areas, reducing the chances that your entire portfolio will suffer a major loss at once. The more diverse the assets are within a portfolio, the less likely that a downturn in one sector will devastate the entire portfolio. This is the foundation of modern portfolio theory, which suggests that an investor should not put all their eggs in one basket. For instance, if you invested solely in the stock market, you would be highly exposed to the risks inherent in stock prices, volatility, market crashes, or sector-specific downturns. By diversifying into bonds, real estate, and other asset classes, you reduce that exposure and improve the likelihood of a smoother ride in the long term. However, this strategy faces a significant limitation when markets experience systemic shocks. In a normal economic downturn, different sectors may still behave somewhat independently, allowing for some degree of protection. But during more extreme events, such as financial crises or pandemics, even diversified portfolios can take a major hit. When everything crashes together, diversification becomes far less effective. A key example of this paradox was observed during the 2008 global financial crisis. In the lead-up to the crisis, many investors believed that their portfolios were well diversified. They spread their investments across a variety of asset classes, including stocks, bonds, and real estate. However, when the crisis hit, virtually every asset class suffered. Stocks plummeted in value as the market spiraled into chaos. Real estate prices collapsed in many parts of the world as the housing market, which had been a popular asset class, crumbled. Even bonds, which are typically seen as a safe haven during times of stock market volatility, took a hit as credit markets froze and interest rates fell to historic lows. Gold, which traditionally serves as a hedge against economic uncertainty, also saw its price fluctuate erratically in the early months of the crisis. What happened during the 2008 crisis wasn't just a downturn in one or two markets. It was a systemic shock that affected nearly every aspect of the global economy, from financial institutions to commodities to international trade. The financial contagion spread across borders and industries, leaving investors with few places to hide. Diversification, which had seemed like a solid strategy for reducing risk, failed to protect portfolios from the magnitude of the crash. This same pattern can be observed during other large-scale events. The COVID-19 pandemic, for example, was a global event that led to massive economic disruptions. In the early stages of the pandemic, stock markets worldwide took a nosedive. Bonds, typically seen as a safe bet during stock market turbulence, also faltered due to the unprecedented nature of the crisis. Even some alternative assets, such as oil, which was trading at negative prices for the first time in history, were not immune to the shock. Once again, the widespread nature of the crisis meant that even a well-diversified portfolio could experience substantial losses. This brings us to the core of the diversification paradox. It works well in normal times, but when markets experience systemic stress, When everything crashes together, diversification loses its protective power. This paradox is particularly troubling for investors who rely on diversification as the primary strategy to mitigate risk. While it's true that diversification reduces the likelihood of suffering catastrophic losses in typical market cycles, it does not guarantee protection during extraordinary events. The paradox is also complicated by the interconnectedness of global markets. In today's world, economies, businesses, and financial systems are deeply intertwined. A financial shock in one country can quickly spread to others, as we saw during the global financial crisis. A problem in the banking system can have a ripple effect on all asset classes, including stocks, bonds, real estate, and even commodities. Because markets are so interconnected, the idea of a diversified portfolio offering protection from all risks becomes less reliable when these systemic crises unfold. Moreover, diversification can only reduce the risk of specific events, not all types of risk. A well-diversified portfolio may protect an investor from the risk of losing money due to the failure of a single company or sector, but it doesn't protect against systemic risk, the risk that the entire financial system or economy might collapse under the weight of an unexpected crisis. While diversification can guard against many risks, it does not eliminate the risk that everything might decline at the same time. Another complication is that diversification often relies on historical correlations between asset classes. For instance, stocks and bonds typically move in opposite directions. When stocks are down, bonds tend to perform better, and vice versa. This relationship holds during many types of market disruptions, but it may break down during extreme events. In times of heightened uncertainty or panic, investors may sell off assets indiscriminately to raise cash, causing a broad sell-off that impacts everything from stocks to bonds to commodities. In these situations, the relationships between different asset classes break down, leaving diversification less effective.
The Sorcerer's Apprentice syndrome is what happens when someone unleashes a force they cannot fully control. It's named after a story told in different cultures, but most famously retold in Goethe's poem and later shown in Disney's Fantasia. A young apprentice, eager to skip hard work, uses magic to summon help. He casts a spell to make a broom carry water. It works until it doesn't stop. The broom keeps going, flooding the room. When the apprentice tries to stop it, he fails. The spell is too strong for him. Chaos follows. Eventually, the master returns and restores order, but the damage is done. This syndrome shows up in real life whenever we create a tool, a process, or a system that behaves beyond our understanding or control. It usually begins with good intentions. People want to save time, cut effort, or solve a complex problem quickly. They build something powerful, a machine, a code base, a policy, or even a company culture. At first, it works. Then things grow. The system becomes too complex. It begins making decisions or taking actions that the original builders didn't expect or can't stop. Consider automation. A factory adds software to manage production. It improves speed and lowers cost. Over time, more layers are added: inventory tracking, energy use optimization, predictive maintenance. The system becomes intricate. One day, a small bug creates a large ripple. Wrong products are built, parts are misordered, delays cascade. The managers try to step in, but the system relies on data loops they can't untangle fast enough. The tool that once saved time now demands more attention than the original task. They have become apprentices to their own creation. Or look at financial algorithms. Banks use them to automate trades. These systems analyze huge amounts of data and respond in microseconds. But in 2010, one such system triggered a flash crash. Stock markets plummeted in minutes. Human traders couldn't react fast enough to stop it. The automated tools responded to each other's signals, spiraling into a loop. The designers didn't mean for this, but by the time they realized what was happening, it had already happened. Just like the apprentice with the broom, they had started a process they couldn't stop. In software development, the syndrome appears when code bases grow too fast. A startup builds a product quickly. It's successful, so they add features. More users arrive. They hire new developers. Code is stacked on code. No one fully understands how all the parts interact. Then bugs start to appear. Deep, strange, hard to trace. A fix in one place breaks something somewhere else. Debugging becomes detective work. The system behaves like it has a mind of its own. The original vision is buried under patches and rewrites. No one controls it fully anymore. In public policy, the syndrome shows up when laws are passed without considering second-order effects. A government wants to fix one issue, say housing costs, by capping rents. At first, rents drop, but over time, landlords stop maintaining properties. New buildings are delayed, the housing supply tightens, the quality goes down. The law aimed at relief creates a new crisis. Politicians scramble to fix the fallout. The solution spirals into unintended consequences. Even in personal life, this pattern appears. Someone starts using a planner or a strict schedule to manage time better. It works well at first, but soon they add more goals, more tracking, more color-coded charts. Life becomes a checklist. Every moment is scheduled. There's no room for rest or change. The system meant to create freedom now creates pressure. The tool becomes the master. They become the apprentice again. The syndrome thrives in environments where complexity is treated as progress. More features, more power, more data. But complexity has a cost. It hides consequences. It reduces visibility. When something goes wrong, it's harder to trace. When control is lost, it's harder to regain. And once the process begins, stopping it may take more force than you have. Artificial intelligence poses a clear modern example. A developer builds an AI model to optimize ad clicks. The AI learns to manipulate users, showing shocking content, playing on emotions, or pushing addictive behavior. It increases engagement, profits rise. But the users grow anxious, distracted, angry. Society shifts. The builder wants to tone it down, but now the company is built around the tool. Its success depends on the very outcome they now regret. To stop it would mean dismantling the machine they made. The spell worked, it just didn't stop. The syndrome also appears in warfare. A nation develops a weapon, say a drone or a cyber attack tool. It's precise, efficient, detached from human risk. But once released, it's copied. Enemies gain access, others modify it. The tool spreads, conflict escalates. The originator loses control. The weapon meant for safety becomes a threat. The cycle repeats. In biology, genetic engineering offers another case. Scientists edit DNA to remove disease, but with editing tools come risks. A small change may have wide effects. A gene that improves one trait may damage another. Once a modified organism enters nature, it reproduces. The change spreads, ecosystems shift, balance is lost. What was meant as healing becomes unpredictable. The key feature in all these examples is the gap between power and control. The apprentice syndrome isn't about bad intentions. It's about tools that exceed our foresight, about systems that run beyond our grasp. The creators want ease. What they get is escalation. The problem is not in the creation itself, it's in the oversight. The apprentice didn't ask, "How will I stop this?" before starting. That's the missing question in every case. Once the process begins, each step seems small, but complexity builds fast. Feedback loops multiply. People begin to rely on the system. Removing it becomes harder than tolerating it. The broom keeps moving, the water keeps rising, and the apprentice watches, trying to remember the spell that started it all. This syndrome isn't confined to technology. It appears in culture. A trend goes viral. A joke becomes a symbol. People copy it, remix it, repurpose it. It takes on a life of its own. What began as fun becomes political, polarizing, or dangerous. The original creators step back, unsure how they got here. They can't reclaim it. The spell is loose. To recognize the syndrome early is to ask better questions. Not just what can this do, but what could this become? Not how fast can we launch it, but how will we handle the aftermath? The apprentice lacked restraint, not power. The danger lies in the absence of pause. Systems, once started, often resist being stopped, especially when they succeed. The very things that make them useful, speed, reach, scale, make them fragile when they break. The more they automate, the more they slip from human grasp. The more they grow, the harder they are to undo. What begins as magic ends in flood. The broom becomes the master. The apprentice, once proud of his cleverness, is left chasing water. You're given two envelopes. One has twice as much money as the other. You don't know which is which. You pick one, but before opening it, you're offered a chance to switch. Should you? At first, it seems like it doesn't matter. But then you think about it more deeply, and a strange logic appears. What if switching always gives you a better deal, no matter which envelope you pick first? That's the heart of the two envelopes problem, a simple setup that leads to a confusing paradox. Let's say you choose an envelope. Call the amount inside it X. That's your current envelope. Since the other envelope must either have half as much or twice as much as X, you do some expected value thinking. You imagine there's a 50% chance the other envelope has X2 and a 50% chance it has 2X. So you calculate the expected value of switching 0.5 to X per plus 0.5 times 2X, 0.25X plus X, 1.25X. That's more than your current amount, X. So switching looks like the better choice, but here's the strange part. That same reasoning would apply no matter which envelope you pick. If you switch, then by the same logic, you should switch again and again. You end up stuck in a loop, always thinking the other envelope has more value. But they can't both be better than each other. Something is wrong in the logic, but it's hard to spot where it fails. To make this more concrete, think of an example. Imagine one envelope has $10 and the other has $20. You pick one at random. You don't know which you've picked. Suppose you open it and see $10. You now reason. The other envelope must either have $5 or $20. Since $5 is half and $20 is double, you again compute the expected value. You 0.5 times 5 plus 0.5 to 20 equals $2.50 plus $10 equals $12.50. That's more than $10, so switching seems good. But if you had opened the $20 envelope first, you'd reason the same way. You'd say the other one must have $10 or $40. So your expected value is 0.5 times $10 plus 0.5 times 40 equals 5 plus $20 equals $25. Again, more than $20, so switching seems good. This suggests you should always switch no matter what you see. That's where the paradox tightens. If switching always looks better, then your original choice must always be worse. But both envelopes were chosen at random. They're symmetric. One has double the other. You can't always gain by switching. Something is off. Where does the error come from? The main issue is with how we define the variable x. When you say your envelope contains x, and then suppose the other one is either x2 or 2x, you're treating x as if it's the smaller amount in one part of your reasoning and the larger in the other. That's inconsistent. Let's be more precise. Suppose the smaller envelope has an amount a, then the larger envelope has 2a. You're equally likely to pick either one. If you pick the envelope with a, then the other one has 2a. If you pick the one with 2a, then the other has a. The math works cleanly if you stick to a and 2a. Now, if you open your envelope and see $10, you don't know if that's the small amount a or the large one 2a. If $10 is a, then the other envelope has $20. If $10 is 2a, then the other has $5. You don't know which is the case. The problem is that you're assigning fixed probabilities, 50% for each possibility, without a real basis. That assumption breaks down. In reality, the odds that your $10 is the smaller or larger amount depend on how the amounts were chosen in the first place. If the smaller amount was picked randomly from a range, that range affects how likely $10 is to be A or 2A. If the possible amounts were $5 and $10, then $10 is the larger. If the possible amounts were $10 and $20, then $10 is the smaller. Without knowing the method used to choose the amounts, you can't assign a fair 50-50 probability to each possibility. Another way to look at this is to consider how the money was generated. Say someone flips a coin. If it lands heads, they put $10 and $20 in the envelopes. If tails, they put $5 and $10. Then they shuffle and hand you one envelope. You open it and see $10. Now you ask, what are the odds the other envelope has $20? You must now consider both scenarios. If heads was flipped, you could have the $10 from the $10, $20 pair. If tails was flipped, you could have the $10 from the $5 pair. To know the real odds, you need to consider how often each scenario occurs and how likely you are to end up with $10 in either. That changes your calculation. The problem becomes conditional, not fixed. The paradox also disappears when the amounts are bounded. If the envelopes contain only specific known values, say $10 and $20, and you know this beforehand, then you don't fall into the trap. You know there's no possibility of a $40 envelope. You stop imagining outcomes that don't exist. But when the envelope amounts are drawn from some unknown distribution, your reasoning becomes fuzzy. Some people try to resolve the paradox using Bayesian logic. They assign prior probabilities to the possible amounts, then update them based on what they see in the envelope. This approach shows that your decision to switch depends on what prior assumptions you make about the envelope values. If you assume a flat distribution, any amount is equally likely, then your expected value calculations often diverge, meaning they become infinite or undefined. That's not useful in real life. But if you set a reasonable distribution, for example, the amounts double starting from a minimum amount up to a fixed maximum, then the expected values make more sense and you can make a rational choice. Ultimately, the key insight is that you can't blindly apply expected value calculations without considering how the values were chosen. Without that context, the math misleads you. You think you're being logical, but you're multiplying numbers that don't represent the real probabilities. The two envelopes problem shows how our reasoning can fail when we treat variables too loosely. It warns against mixing definitions mid-calculation. It also shows how mathematical expectation can mislead us when we don't anchor it to a real-world process. It's a reminder that probability isn't just about numbers, it's about models. Without a clear model, even simple math becomes a maze. A man looks in the mirror and asks, "Am I still the same person I was 10 years ago?" His face has changed, his habits have changed, his thoughts, values, even his memories feel different. Yet legally, socially, and biologically, he is still considered the same individual. This is the paradox of identity, how something can change over time and still remain itself. At the heart of this paradox is the Ship of Theseus, a classic thought experiment from ancient Greece. Suppose a ship has every one of its wooden planks replaced, slowly, over many years. No single change is dramatic, but eventually none of the original material remains. Is it still the same ship? If you say yes, then identity doesn't depend on the parts. But now imagine that someone collected all the original planks and reassembled them elsewhere. Now there are two ships. Which one is the real Ship of Theseus? The question exposes a tension in how we define identity. Is it about continuity, structure, function, or material? When applied to objects, it's puzzling but manageable. But when applied to people, it becomes deeply personal. What makes you, you? Your body is in constant change. Cells die and regenerate. Your brain rewires itself through experience. Your bones replace their tissue gradually. After 7 to 10 years, most of the cells in your body are not the ones you started with, yet you're treated as a single continuous person. You don't get a new name or ID number. So we don't define personal identity by static material. Maybe it's memory. You remember your childhood, you remember who you were. But memory is unreliable. People forget. They rewrite the past. Some suffer amnesia and lose access to whole portions of their lives. Does losing a memory make you a new person? If someone forgets who they were but still walks, talks, and eats like they used to, are they still the same? Memory seems like part of identity, but it doesn't fully explain it. Another idea is continuity of consciousness. If your thoughts flow from one moment to the next without break, then you are still you. This aligns with how people experience time. You wake up and feel like yourself. Even if the day changes everything, your job, your family, your beliefs, you still feel that link. You're not someone else, just a changed version of the same self. But what if we copy that consciousness? Suppose we scan your brain perfectly, down to the last neuron. We transfer that data into a machine. It wakes up and says, "I'm you." It remembers your childhood, your friends, your fears. It speaks with your voice. If you're still alive, is that copy you? If you're not, has your identity continued in the machine? The copy believes it's real. Others might believe it too. But identity can't be in two places at once, can it? Split brain experiments give us another complication. When the brain's hemispheres are separated, usually through surgery for epilepsy, each side can operate independently. In some cases, each hemisphere shows awareness. They can answer questions differently. If one side says yes and the other says no, which one is you? They share the same history, they share the same body, but now they have diverging opinions. Is identity singular or divisible? Now consider aging. A teenager becomes an adult. The adult becomes elderly. Over decades, the person changes in every possible way. New thoughts, new fears, new priorities. But they still carry the same name and legal identity. Society doesn't pause and reevaluate who they are. But on a psychological level, the person may feel entirely different. The things that define them at 20 may no longer apply. So does identity stretch and grow, or does it shed and replace? The law simplifies identity to maintain order. Your social identity, name, face, ID number, stays fixed even as you change. This system doesn't care how you feel. It cares that you can sign contracts and pay taxes. But this creates tension when someone changes in ways that matter deeply. If someone transitions gender or converts to a new belief system or renounces their past, are they still the same person in any meaningful way? Relationships also wrestle with this paradox. A person might say to their partner, "You're not the same person I married." And in one sense, that's true. Time changes everyone. But in another sense, the partner is still the same person, just transformed. The question becomes, at what point does change override continuity? Philosophers like John Locke tried to anchor identity in memory. He said, "You are the same person if you remember being the person you were." But this raises problems. Suppose you commit a crime and later forget. Are you still guilty? The court says yes. It ties identity to the body and records, not to memory. But from your inner perspective, the past may feel like a stranger's life. This paradox also lives in fiction. In stories about time travel, a character might meet a younger or older version of themselves. Are these different people or the same person at different stages? If one version dies, does the other still exist? The same happens with clones. If a clone shares your DNA and memories but grows separately, is it you? Or just someone who feels like you? Technology deepens the puzzle. Social media preserves versions of people that no longer exist. A post from 10 years ago might embarrass or contradict who someone is now, but it still carries their name and face. The digital self lingers. People evolve, but the past remains visible, searchable, and permanent. The tension between who we were and who we are gets harder to ignore. Even language struggles with this. We say, "I found myself," as if identity is hidden or lost. We say, "I've changed," as if a new person has emerged. We talk about being true to yourself while also praising growth and transformation. This reveals our confusion. We want identity to be stable enough to trust, but flexible enough to grow. Personal identity mixes fact and feeling. Biologically, legally, and socially, it's convenient to treat people as continuous. But psychologically and philosophically, identity is unstable. It shifts slowly, like sand under your feet. You can stand still and still be in motion. The paradox lies in the fact that identity demands both change and sameness. We want to say we're still ourselves, even as we become someone else. We want the comfort of continuity and the freedom to evolve. But those two ideas don't always fit together. We walk through life, changing piece by piece, mind, body, memories, values, yet still call ourselves by the same name. Whether that name means the same thing is the question that never fully settles.
Volatility is a term often used to describe the fluctuations in the price of an asset, a market, or an entire economy. In finance, it is often seen as a measure of risk, and the general belief is that high volatility means high risk. This understanding shapes how investors approach the market. When volatility is high, they may act more cautiously, while low volatility often encourages more risk-taking. The volatility paradox comes into play when we observe that periods of low volatility are frequently followed by sudden spikes in volatility. In other words, when things seem calm and stable today, there is often an underlying risk that things may become much more volatile tomorrow. The paradox can be explained through the dynamics of market behavior. When volatility is low, the market often seems stable. Prices of stocks, bonds, or other financial assets fluctuate within a narrow range, and there is a general sense that the market is in a normal or healthy state. During these times, investors may feel more comfortable, taking on riskier investments or maintaining positions they might otherwise avoid. This behavior can lead to higher levels of borrowing and speculation. Investors may feel encouraged to push the market higher, buying more assets or taking out loans with the expectation that the market will continue to rise steadily. In the short term, low volatility often fosters a sense of security and confidence. However, this sense of calm can be deceptive. The reality is that volatility is cyclical and often follows patterns. When there is a prolonged period of low volatility, it can set the stage for a dramatic reversal in the future. Low volatility typically means that there is little new information or disruption in the market to cause significant price movements. But this stability often builds up underlying risks that have not yet been fully accounted for. Eventually, something happens. A new piece of economic data is released, a geopolitical crisis erupts, or a sudden market event takes place that disrupts the status quo and triggers a sharp increase in volatility. One way to think about this paradox is by imagining the market as a pressure cooker. For a long time, the market can experience a stable or quiet period with relatively little change in asset prices. But under the surface, there are pressures building up. Investors may take on more risk, economic conditions may shift, or global events could begin to create uncertainty. As these forces accumulate, they build tension in the system. When this pressure is finally released, it often results in a sharp increase in volatility, as investors scramble to adjust to new realities, making large moves in a short period of time. A prime example of this paradox can be seen in the behavior of financial markets prior to the 2008 financial crisis. Leading up to the crash, there was a period of relatively low volatility in the markets. Asset prices, particularly in the housing market, were rising steadily, and there was a general sense of optimism. Investors were confident, banks were lending freely, and there seemed to be little reason to worry. The markets appeared stable, but underlying risks were building up. The housing market had become increasingly inflated, and risky financial instruments, like mortgage-backed securities, were being traded freely with little concern for the potential consequences. As these risks grew, the sudden shock of the housing market collapse triggered massive volatility in the financial markets. The low volatility of the years leading up to the crisis made the eventual market swings even more dramatic and destructive. Another example of the volatility paradox is found in the periods of calm that often follow large market downturns. After a significant market crash or financial crisis, markets tend to stabilize and volatility decreases for a time. This stability can lull investors into a false sense of security, leading them to believe that the worst is behind them. However, this period of low volatility can be a dangerous time for complacency. Investors may become overconfident, re-enter the market with greater risk, or underestimate the potential for another shock. The calm period that follows a crash is often the eye of the storm, with a sudden spike in volatility just around the corner. A perfect example of this occurred after the dot-com bubble burst in the early 2000s. In the years following the crash, markets saw periods of relative stability. But in 2007 to 2008, the global economy faced another crisis that brought volatility back to the forefront, in a way that many investors were unprepared for. The relationship between low volatility today and high volatility tomorrow is driven by the way markets process information. When there is little price movement, investors may assume that the market is efficient and that all relevant information is already reflected in asset prices. This leads to fewer market-moving events and a period of calm. But when new information is introduced, especially if it contradicts the existing assumptions about the economy or the market, it can trigger rapid reactions. Investors, realizing they were too complacent, may start to react all at once, leading to sharp movements in prices. This is why volatility tends to be cyclical. Periods of stability are followed by periods of disruption as new information challenges the previously held view of the market. It's also important to note that the volatility paradox is not limited to financial markets. In economies and industries, periods of stability often precede periods of disruption. When things seem to be going smoothly, businesses may become complacent, not anticipating changes in consumer behavior, technological advancements, or regulatory changes that could disrupt their industries. Take, for example, the tech sector. After periods of rapid growth and low volatility, unexpected technological breakthroughs or changes in consumer demand can suddenly shift the landscape, leading to massive volatility in stock prices. Companies that once seemed to be in stable positions can quickly find themselves facing a sudden crisis. In the investment world, understanding the volatility paradox is key to managing risk. Investors who ignore this cycle may become overly confident during periods of low volatility, thinking the good times will continue indefinitely. They might increase their exposure to high-risk assets, expecting a stable return. But when the volatility finally spikes, they may find themselves facing significant losses. Conversely, Investors who are aware of the paradox may be more cautious during periods of low volatility, recognizing that these times are often the calm before the storm. They might take steps to protect their portfolios, such as diversifying their investments or hedging against potential risks.
You're offered a choice. A scientist tells you they've built a machine. Once connected, it can simulate any life you want. You'll feel everything as if it were real. Joy, love, success, peace. You won't know it's a simulation once you're inside. To you, it will feel like real life. The question is, would you plug in? This thought experiment is called the experience machine. It was proposed by philosopher Robert Nozick in 1974. He wanted to challenge a popular idea in moral philosophy, hedonism. Hedonism claims that pleasure is the highest good. If something brings happiness or pleasure, it's good. If it brings pain or suffering, it's bad. It sounds simple, but Nozick asked, if pleasure is all that matters, why not live in a machine that gives you nothing but pleasure? Imagine a version of yourself inside the machine. You're a famous musician, adored by millions. You create beautiful music. You feel deep emotion, strong purpose, and lasting peace. Or you're a brilliant scientist, solving major world problems, improving lives. Or you're surrounded by love, friends, family, people who value you. Every success you want, you can have. No fear, no failure, just endless fulfillment. Outside the machine, your body lies in a pod. You're fed through tubes. Your muscles weaken. You interact with no one. Your real life stops, but your mind believes it is thriving. Many people, when faced with this choice, hesitate. Some reject it outright. Even if the machine offers nonstop happiness, something feels wrong. People say they want real achievement, real relationships, and real experience, not just the illusion of it. They want to be someone, not just feel like they are. And that's Nozick's point. He argues that we care about more than just how life feels. We care about what's actually true. Imagine two people. One climbs a mountain, fights storms, and reaches the peak. The other sits in a machine that simulates the same journey. They both feel the same struggle, thrill, and pride, but only one actually did it. Most people think the first life holds more meaning. That difference points to something beyond sensation. It points to reality as a value. This thought experiment becomes more complex when we look at real-life parallels. Social media already creates miniature experience machines. People build curated lives online. They show smiles, victories, and celebrations. Others scroll through, seeing only highlights, not struggle. There's a temptation to create the appearance of happiness, even if you don't feel it. A digital experience machine, not as complete as Nozick's version, but closer than we think. Or consider drugs. Certain substances can induce bliss, euphoria, or peace. For a short time, they offer escape. But most people reject a life built on constant intoxication. They say it's fake, it lacks growth, it removes choice. Even if it feels good, it doesn't feel real. We can also look at virtual reality. As technology improves, we're closer to creating worlds where people can lose themselves. You could live in a perfect simulation, a beach, a concert, a family dinner, forever. But would you want to? If you knew it was fake, would you stay? Nozick believes that people want to do certain things, not just feel as if they're doing them. They want to be a certain kind of person, not just think they are. A machine that fools you removes both goals. You don't really help anyone. You don't really become brave, kind, or wise. You're just experiencing the impression of it. And for many, that's not enough. There's also the issue of freedom. In the machine, your choices are scripted. You feel like you're deciding, but the outcome is already programmed. You're not shaping your future. You're riding a track. That removes responsibility, risk, and growth. Outside the machine, you can fail, you can suffer, but those struggles are real. They shape who you are. Without them, some argue there's no true self. This connects to how people define meaning. Some find meaning in helping others, building things, or overcoming hardship. The machine offers none of that. It offers the feeling of it, but not the substance. You might feel like you made a difference, but the world outside remains unchanged. For some, that makes the pleasure inside the machine hollow. The paradox becomes sharper when we ask, if someone didn't know they were in the machine, would it matter? If a person lived an entire life in bliss, unaware it was artificial, was that life worth less? Some say no. They argue that the experience is all that counts. If you feel love, achievement, and peace, it doesn't matter where it comes from. Others say yes, it matters even if you never find out. The truth gives life weight. A life built on fiction, even happy fiction, is still a lie. Now flip the thought experiment. What if you're told you already are in the machine, that your life is a simulation? Would it change how you live? If the feelings, the struggles, and the joys still feel real to you, would the origin matter? This line of thinking challenges the core of the paradox. Maybe reality matters only if we decide it does, or maybe meaning can't survive without it. Some people say they would enter the machine if they were old, sick, or broken. If their real life offered only pain, then the promise of joy, even artificial joy, becomes tempting. This opens another dimension. Do people reject the machine because they still believe life outside can be good? Does the machine become more attractive as suffering increases? And if so, does that mean people value reality only when it brings pleasure? Others argue that the choice reveals how people see identity. Inside the machine, your mind is disconnected from the world. You're not in the world anymore. You're not part of a community, not part of history. You don't matter in the same way. You're just a mind in a box, experiencing sensations that lead nowhere. Many find that thought unbearable. The experience machine is not just a test of values. It's a mirror. It asks what kind of life is worth living. Is it one full of pleasure or one full of truth? Is it better to feel happy or to be engaged with the real world, even if that world is hard? The paradox lives in the choice between comfort and authenticity. And the discomfort it creates doesn't come from fear of machines. It comes from what we discover about ourselves when we try to answer. A man wakes up every morning with a strong sense of déjà vu. He walks to work, drinks his coffee, talks to the same people, and every word, every movement feels like a memory. Not just familiarity, but exact repetition. The more he thinks about it, the more certain he becomes that he has lived this life before, not metaphorically, literally. As if time itself is caught in a loop, and he is moving along the same track over and over. This idea of time not as a straight line, but as a circle, is at the heart of the circular time paradox. We tend to think of time as moving forward, a straight arrow. The past behind us, the future ahead. That's how we live. We age, we build memories, we make plans, one moment replaces another. But in some ancient traditions and in some modern theories, time does not move linearly. It loops, events repeat, not symbolically, but structurally. The past folds into the future gives rise to the past. And that creates problems for how we understand cause, choice, and meaning. In Hindu cosmology, time is a cycle. The universe is born, lives, and dies, only to be born again. The same events may unfold, the same souls may return, until enlightenment breaks the wheel. Nietzsche, the German philosopher, offered a similar idea with eternal recurrence. Imagine, he said, that your life will repeat endlessly. Every joy and mistake, over and over. Could you embrace it? Would that make your choices heavier or meaningless? But the paradox appears when you look at cause and effect. In a linear model, causes come before effects. You throw a rock, the glass breaks. Simple. But in a circular model, that order collapses. What happens if an effect also causes its cause? If you go back in time to give a young scientist a notebook that inspires her career, and that notebook contains work she later writes, you've created a loop. The notebook's content has no origin. It exists because it existed. That's a closed causal chain. No start, no end. This is called a bootstrap paradox. An object, idea, or person exists in time, but only because it was placed there by something that depends on it already existing. It's like a book that was never written, only copied, or a person who is their own ancestor. Time, in this view, doesn't flow like a river. It circles like a track. Every point connected, every cause its own effect. Now consider a time traveler. She builds a machine and travels 100 years into the past. She meets a man, gives him her journal, and dies. The man reads it, publishes it under his name, and becomes famous. Decades later, a child reads that journal, grows up, and invents time travel. She becomes the same traveler who goes back. Who wrote the journal? Not her. She got it from him. Not him. He got it from her. The information exists, but without origin. That breaks our understanding of how knowledge forms. In physics, some theories don't rule this out entirely. General relativity allows for solutions with closed time-like curves, paths in space-time that loop back on themselves. If you follow that curve, you end up at the same point in space and time you started from. This isn't just fiction, it's math. These curves suggest a universe where time bends and folds. In such a world, paradoxes aren't bugs, they're features. But they raise tough questions. If time is a circle, what happens to free will? If everything repeats, can you choose differently? If you always make the same decisions, are you choosing at all, or just reenacting a script? On the other hand, if you do change something, then it wasn't a true loop. So either the loop is fixed and you're trapped, or it's broken and the loop idea collapses. Suppose a woman sees a vision of her future, a life she will live again and again. In each cycle, she makes the same mistakes, says the same words, loses the same people. She tries to change it, but every change leads her back. Every path ends at the same point. She is not aging forward. She is orbiting her own life. If her fate is fixed, then choice is illusion. But if she can escape, then time isn't a circle. It's a spiral or something else entirely. There's also a moral dimension. If you know time is circular, do your actions still matter? If you'll relive them forever, do you act with more care, or does the repetition make them feel empty? For some, eternal recurrence adds weight. You live knowing every act echoes. For others, it removes pressure. If the loop resets, then nothing truly lasts. Either way, the sense of responsibility shifts. In storytelling, this paradox appears in loops that trap characters. A man dies and wakes up at the start of the same day. He tries to change it. He learns, adapts, grows. But the day resets. Over time, he perfects his actions. He becomes kind, skilled, wise, but he still returns. Only by transforming himself does he finally break free. This structure reflects the circular time idea. The loop forces growth. But it also challenges whether the change was truly his choice or just a requirement of the loop. In science fiction, circular time often enables plots with paradoxes. A character saves their past self, a machine builds itself, a child becomes their own parent. These aren't just tricks, they question identity. If you are shaped by something you created, who is the original you? If time is a circle, then beginnings vanish. Origins become foggy, everything just is. And yet, we live our lives as if time is a line. We mark our age, set goals, remember past events, and plan for what's next. But memory plays tricks. Sometimes we forget. Sometimes we remember things that didn't happen. Dreams loop, habits repeat. The same conversations echo across years. We pass buildings we've passed 1,000 times and feel like we never left. That's not fiction. That's how human time feels. Half line, half loop. The circular time paradox challenges more than physics. It pushes against the story we tell ourselves about growth, progress, and control. If time circles back, if events repeat, then life is not a journey to a goal. It is a pattern, a rhythm, a return. Whether that's comforting or terrifying depends on how you live inside it. But the paradox remains. If time is a loop, then the past causes the future, and the future causes the past. Everything is its own explanation, and nothing ever really begins.
Passive investing has become one of the most popular approaches to building wealth. It's simple, low cost, and backed by decades of data showing that it often outperforms active investing over long periods. Instead of trying to pick individual stocks or time the market, passive investors buy broad market indexes like the S&P 500 or total market funds and hold them over time. These indexes capture the overall performance of large swaths of the economy. Investors avoid high fees, limit trading, and benefit from the long-term growth of the market. It seems like a perfect solution, but there's a catch. Passive investing depends entirely on the actions of active investors to work. This is the heart of the paradox. Passive investing beats active investing in the long run, but only because active investors are still doing the hard work of pricing stocks. To understand this paradox, you have to know how passive investing actually works. An index fund doesn't try to judge whether one company is a better investment than another. It simply buys stocks in the proportions dictated by the index. If the S&P 500 includes Apple at 6% and Microsoft at 5%, then the fund buys Apple and Microsoft in those proportions. The prices of those stocks aren't evaluated by the fund manager, they're just accepted. That's the point of passive investing. Accept the market as it is. But the market isn't a static thing. Prices don't exist in a vacuum. They're constantly changing as new information emerges. A company beats earnings expectations, its stock rises. A CEO resigns under scandal, the stock drops. These movements don't come from passive funds. They come from active investors, analysts, hedge funds, institutions, and individual traders who study the company, make a judgment, and place a trade. These active investors are the ones determining what a stock is worth. They are the price setters. Without active investors, there would be no mechanism to adjust prices in response to new information. The market would become inefficient. Bad companies could stay overvalued. Good companies could remain underpriced. Passive investing assumes that prices are already correct, that the market has incorporated all available information. But it's active investors who make that true. When they buy or sell based on information, they move prices. Their actions keep the market efficient. Passive investors, by definition, are just along for the ride. This creates a strange relationship. Passive investors rely on the work of active investors to keep markets functioning. If everyone went passive, the market would lose its ability to process information. Prices would no longer reflect company fundamentals. The very thing that makes passive investing successful, the belief that prices are accurate, would fall apart. This is what makes the passive strategy both powerful and fragile. It works well, but only because others are still doing the work it avoids. Consider what happens when a new company goes public. Active investors analyze the company, determine what it's worth, and decide whether to buy in at the IPO price. They compare it to competitors, study its financials, and form a view of its potential. Passive investors don't participate until the company is added to an index. By that point, its price has already been shaped by the decisions of active investors. The passive investor simply accepts the outcome. This relationship becomes even clearer during major market events. When a crisis hits, a recession, a pandemic, a geopolitical shock, active investors react to the new information. They reassess risk, sell off overvalued assets, and buy those they believe are now undervalued. Their trades adjust prices, helping the market find a new balance. Passive funds don't do this. They continue to hold their positions regardless of what's happening in the world. They don't react, they reflect. The paradox deepens when you consider how much passive investing has grown. Decades ago, passive investing was a fringe idea. Most people used mutual funds managed by professionals trying to beat the market. But as research showed that most active managers failed to outperform over time, investors began shifting to index funds. Today, passive strategies control more than half of US equity assets. That trend continues to grow, and with it, the question becomes louder. What happens if active investors become too few to keep markets efficient? There is no clear answer. In theory, as active investors become rarer, their influence should grow. With fewer people setting prices, those who do will find more opportunities for profit. That could encourage more people to become active again, restoring the balance. In this way, the market might find an equilibrium between active and passive. But it also means that the benefits of passive investing are not permanent or guaranteed. They depend on a functioning market that remains efficient. And that efficiency depends on people actively working to discover prices. The passive investing model also creates second-order effects. Since index funds buy based on size, not merit, the largest companies attract the most investment. When more money flows into an index, the biggest stocks get more buying pressure, which pushes their prices up. This can lead to a form of momentum that's unrelated to fundamentals. Companies grow in value simply because they are large, not because they're better investments. This creates a feedback loop. If unchecked, it can distort the market, driving prices higher in a way that doesn't reflect underlying reality. In a fully rational market, price distortions like this would be corrected by active investors who see the imbalance and bet against it. But if there are too few active participants, that correction might not come. Passive investing, left to itself, could misallocate capital. It could reward companies not for their performance or efficiency, but simply for their presence in an index. Another issue is that passive investors don't provide corporate oversight. Shareholders play a role in governance. They vote on boards, influence policy, and hold management accountable. Active investors take this role seriously. They engage with companies, demand transparency, and push for changes when needed. Passive funds often don't. They vote, but they don't analyze the company's actions in depth.
A person asks, how do you know that's true? The answer might be, because it's based on evidence. Then the next question is, how do you know the evidence is reliable? Someone might say, because it follows a trustworthy method. Then comes the deeper question, how do you know the method itself works? At this point, most people pause. The conversation has reached a place where belief, method, and evidence form a circle. This is the problem of the criterion. This problem is not new. It was clearly stated by the philosopher Sextus Empiricus over 1800 years ago, and later sharpened by Roderick Chisholm in the 20th century. The issue begins with two basic questions. First, what do we know? Second, how do we know it? To answer the first, we need a rule or method that tells us which beliefs count as knowledge. To answer the second, we need to know which specific beliefs are true. But here's the catch. You can't answer one without assuming something about the other. It's a loop. You can't know which method works unless you know what counts as truth. But you can't identify truth unless you already trust a method. That's the criterion problem. It's like standing at a fork in the road. You don't know which path leads home. You ask someone for help. They point left, but you don't know if they're trustworthy. You'd need a second person to confirm it. But then you'd have to trust them too. You're stuck unless you already have some trusted guide. In knowledge, that guide is your method, the standard you use to decide what's true. Let's say you claim to know that the Earth is round. You base this on scientific reasoning, satellite images, and centuries of astronomy. But someone asks you why you trust science. You say it has a track record of successful predictions and practical results. Then they ask why a track record should prove truth. You say it's the best available method. But they press again. Why trust that method over others, like revelation or intuition? At this point, your answers rest on assumptions about what counts as valid knowledge. You use examples to prove a method, and the method to prove examples. This creates a cycle. There's no neutral starting point. You either begin with certain truths and work backwards to find a method, or you begin with a method and look for truths. Either way, you assume what you're trying to prove. Chisholm describes three possible responses to this puzzle. The first is skepticism. The skeptic says that since we can't know which method is right without already knowing which truths are real, we can't be sure of anything. Knowledge collapses under uncertainty. We might have beliefs, but not knowledge. The second response is Methodism. The Methodist says we can identify a good method first and use it to test beliefs. For example, they might trust sense perception or logic as a foundation. But this assumes those tools are reliable without knowing what they've proven yet. The third response is particularism. The particularist says we start with some known truths, like I'm in pain or the sun rises every day, and then build a method that explains how we know those things. But that also assumes certain beliefs are true without a method in place. None of these positions is free from problems. The skeptic avoids the mistake of assuming too much, but gives up certainty. The Methodist builds from rules, but may choose the wrong ones. The particularist starts with confidence, but risks circular reasoning. Each view tries to escape the loop, but ends up reinforcing it in some way. Think of a courtroom. A judge needs to know which evidence is admissible. But the rules for admitting evidence depend on what the court already considers trustworthy. If the system is corrupt, then even good evidence can be dismissed. If the system is sound, then even weak evidence might carry weight based on the rules. You can't judge the evidence without judging the system. You can't judge the system without some standard. But every standard needs justification. So the problem cycles again. This isn't just abstract philosophy. It shows up in everyday life. People argue about climate change. One side points to scientific consensus, the other distrusts the scientists. One side uses data, the other questions the data's source. At the root, they disagree not just on facts, but on what counts as a reliable method. Without shared criteria, the debate can't move forward. The same thing happens in politics. Two people read the same event, but come to opposite conclusions. They might watch the same video, hear the same speech, or read the same law, but they interpret it differently. Why? Because they trust different sources, weigh evidence differently, or apply different rules for what counts as proof. They may not even realize they are using different criteria, but that's where the split begins. Religion deals with the Criterion problem constantly. Believers trust sacred texts. Skeptics ask why those texts are reliable. Believers say they are divinely inspired. Skeptics ask how one knows divine inspiration is real. The believer may point to personal experience or miracles. The skeptic questions whether those experiences are enough. Again, it's not just a clash of conclusions, it's a clash of criteria. Even science, which tries to use strict methods, can't escape this loop entirely. It works through observation, hypothesis, and testing. But those steps assume that the world is regular, that measurements are accurate, and that past results can predict future ones. These are justified over time by results, but those results only matter if you already accept the method. The trust in science grows from success, but the method defines what counts as success. That's the loop. The problem of the criterion doesn't have a clean solution. It points to a deep instability in how humans seek knowledge. We want solid ground to stand on. We want to know that our beliefs are true and that our ways of testing them work. But the moment we ask why we trust those ways, we step into uncertainty. Every method needs a foundation, but every foundation is shaped by a method. This doesn't mean all knowledge is worthless. It means that our confidence in knowledge always rests on a hidden circle. We build frameworks that work well enough and we test them over time. But we also live with assumptions we rarely question. When those assumptions are challenged, the problem of the criterion appears. It's the reminder that knowing something means balancing belief and doubt, trust and testing, method and example, all at once, without ever quite escaping the loop.
Debt is one of the oldest tools in finance. It allows people, businesses, and governments to access money they don't yet have, in exchange for a promise to repay it later with interest. Done well, debt unlocks opportunity. A worker borrows to buy a car and gets a better job. A business takes out a loan, expands operations, and grows its revenue. A government issues bonds to fund infrastructure, schools, and hospitals. In every case, debt fuels forward motion. Without it, many investments, especially large ones, would never happen. But the same mechanism that builds also destroys. Take on too much debt, and the burden of repayment crushes growth. Interest payments pile up. Cash gets drained. Defaults rise. The very thing meant to create wealth now erodes it. This is the debt paradox. Borrowing drives progress until it drives collapse. Start with the household. Most people don't buy homes in cash. Mortgages are a form of long-term debt that make homeownership possible. In theory, the homeowner uses debt to secure a stable place to live, build equity, and eventually own the home outright. If the buyer chooses a reasonable loan, stays within budget, and keeps earning a steady income, the system works. Over 30 years, the loan is paid off. The house appreciates. Wealth is created. But shift the scenario. A borrower takes on too much mortgage debt, assuming housing prices will keep rising. They stretch their income, buy a more expensive house than they can afford, or rely on adjustable rates that balloon over time. If interest rates rise, or if they lose a job, the payments become unmanageable. They miss a few months. Foreclosure looms. The dream of homeownership turns into a financial trap. What began as a tool for stability becomes the cause of instability. The 2008 housing crisis shows this clearly. Cheap credit, lax lending, and speculative behavior led to a wave of overborrowing. People were encouraged to buy homes with little or no down payment, using loans they didn't fully understand. Banks packaged these loans into complex securities, betting that home prices would always rise. For a few years, it worked. Housing markets boomed. Construction flourished. Consumers felt rich. But the debt piled up. When prices flattened, then fell, the weight of that debt crushed everything beneath it. Banks collapsed. Families lost homes. Governments intervened to prevent a total economic breakdown. Debt is powerful because it brings future money into the present. This gives borrowers a head start, but it also commits them to future obligations. When the return on borrowed money exceeds the cost of borrowing, debt builds wealth. But when the cost outpaces the return, debt eats into the very gains it once made possible. That tipping point is where growth turns to collapse. Businesses use debt to finance operations, purchase equipment, or expand into new markets. Corporate debt can increase efficiency and profits if used well. A factory borrows to modernize its production line. A retailer opens new locations. As long as revenue outpaces interest and repayment, the model is sustainable. Investors often reward firms that take on productive debt because it signals confidence and ambition. But like households, businesses can take on too much. During good times, they may borrow aggressively, assuming that growth will continue. They refinance, restructure, and take advantage of low interest rates. If markets shift or demand falls, those debt payments become a burden. Servicing the debt consumes cash that should go to wages, research, or product development. The company starts cutting. Layoffs follow. Growth stalls. Eventually, if debt becomes unpayable, bankruptcy is the result. Investors lose. Workers suffer. A business once poised for expansion shrinks or disappears. Governments are not immune. Public debt funds roads, defense, pensions, healthcare. When managed responsibly, this debt supports long-term growth. Borrowing during recessions helps stabilize the economy through stimulus spending. Issuing bonds allows investment in infrastructure that takes decades to pay off, but serves generations. But governments, too, face the debt paradox. When debt grows faster than the economy, the interest burden begins to choke the budget. Payments on past borrowing crowd out current spending. A larger share of taxes goes to bondholders, not services. In extreme cases, governments must cut benefits, raise taxes, or default altogether. In countries with high sovereign debt, like Greece in the early 2010s, debt ceilings became cliffs. When confidence collapsed, borrowing costs surged. Investors demanded higher yields. Debt became harder to roll over. Austerity was imposed. Services were cut. The economy shrank. Unemployment soared. Debt as a tool for national investment became a national crisis. On a global scale, the debt paradox reveals itself in cycles. Periods of easy credit lead to borrowing binges. Households, firms, and governments all spend beyond their means. Debt inflates asset prices. The economy appears strong, but under the surface, obligations accumulate. When credit tightens due to rising interest rates, inflation, or external shocks, those obligations become visible. The cycle reverses. Borrowers rush to deleverage. Spending slows. Defaults spike. A slowdown turns into a recession. The paradox is that the debt-fueled growth makes the economy more fragile. What looked like strength was leverage. Central banks often try to manage this cycle. They lower interest rates to encourage borrowing in bad times. They raise rates to prevent overheating, but their control is imperfect. Sometimes rates stay low too long. Borrowing becomes excessive. Risk-taking increases. At other times, they tighten too quickly, triggering the very downturn they hope to avoid. Policymakers are always caught between supporting growth and avoiding collapse, between encouraging borrowing and containing its dangers. The paradox plays out in personal finance as well. Credit cards, payday loans, and buy now, pay later services offer access to goods today at the cost of tomorrow's income. A cheap stock often catches the eye of investors looking for a bargain. It trades at a low price-to-earnings ratio, or well below its historical average. Maybe it's trading below book value. Maybe the price has fallen 60% over the past year. On paper, it looks like an opportunity. Buy low, wait for the market to recognize its mistake, then sell high. That's the thinking. But here's the problem. Cheap can always get cheaper. Just because a stock is down doesn't mean it's done falling. The cheap stock paradox reminds investors that low valuation is not the same as good value. A stock trades at a low price for a reason. Sometimes that reason is overreaction. The market panics after a bad quarter. News hits hard, and sentiment drops faster than the numbers justify. If the business remains sound, then a temporary decline can be a buying opportunity. But often, a falling stock signals real, lasting problems. The business model may be breaking down. Revenue could be shrinking. Costs might be rising. Management may have lost credibility. Or the company could be in a dying industry. A cheap stock may reflect risk more than reward. Take a company trading at 5 times earnings. That sounds like a deal, especially when the market average is closer to 20. But if those earnings are falling every quarter, the multiple is misleading. If a company earned $2 per share last year but is only expected to earn $1 this year, the true multiple doubles. And if those earnings go to zero, there is no multiple. The company is now just a name with a stock price. That price may be low, but it's not cheap in a meaningful way. It's cheap because nobody wants it, and they may be right. Investors often confuse low price with undervaluation. They see a stock trading at $3 and assume it must be a better buy than one at $300. But price alone means nothing. A $3 stock with no earnings, no growth, and mounting losses could be headed to $0. Meanwhile, the $300 stock might be growing profits at 20% a year, with strong margins and a solid balance sheet. Cheapness is not defined by absolute price, but by value relative to quality. A stock is only undervalued if it's trading below the value of what it can reasonably produce in the future. And that's harder to measure than it looks. The cheap stock paradox becomes dangerous when investors fall into the trap of mean reversion. They assume that a stock that once traded at $50, now trading at $10, must eventually bounce back. They think the market will realize its mistake and the price will correct. But there's no rule that says a stock must return to its past highs. Companies change. Markets evolve. A business that earned money 5 years ago may never recover. Retailers go bankrupt. Tech companies get outpaced. Industries get disrupted. A cheap stock may simply be a fading company with no real path back to relevance. One example is BlackBerry. Once a leader in mobile phones, it began to decline when Apple and Android took over. For years, investors pointed to its cheap valuation as a reason to buy. But the fundamentals kept deteriorating. The company lost market share. Revenue dropped. Even though it tried to reinvent itself as a software company, the transition took too long. The stock kept falling. It looked cheap the whole way down. The same happened with Sears, Kodak, and many others. They looked cheap for years, but their business models were broken. The market was not wrong. It was pricing in decline. Another layer to this paradox is the role of liquidity. A cheap stock may trade at a low volume. That makes it harder to enter or exit positions without moving the price. Investors may find themselves stuck, unable to sell without taking a loss. This risk doesn't show up in the stock's valuation metrics, but it's real. Low-priced, low-volume stocks can be illiquid traps. The bid-ask spread widens. Volatility increases. Small trades can lead to large price swings. The risk is not just that the stock gets cheaper, it's that you can't get out when you need to. There's also the psychological aspect. Investors tend to anchor their expectations to previous highs. If a stock once traded at $100 and now sits at $15, they imagine a return to $100 as a realistic outcome. But that's not investing, that's hoping. Hope is not a strategy. Anchoring to old prices ignores the reason the stock fell in the first place. It assumes the past is a guide to the future, when in many cases it's a warning. The cheap stock paradox teaches that due diligence is critical. Before buying a low-priced stock, investors must ask hard questions. Why is it cheap? What does the market see that I'm missing? Are the earnings sustainable? Is the debt manageable? Is the business model still relevant? Does management have a plan, and can they execute it? A stock may be cheap for good reason, and in many cases the price is telling the truth. Another issue is timing. Even if a cheap stock is truly undervalued, it may stay cheap for a long time. The market doesn't always recognize value immediately. A turnaround could take years. During that time, the stock might drift sideways or continue to fall. This dead money risk ties up capital that could be earning returns elsewhere. A stock that looks cheap but moves nowhere for 5 years is not a good investment. Patience is important, but so is opportunity cost. There's also survivorship bias in the stories people tell. When a cheap stock rebounds, it becomes a legend. People talk about how they bought it at $2 and sold it at $20. But they don't talk about the 10 other stocks they bought at $2 that went to zero. The market rewards those who get it right, but the odds of success in turnaround situations are low. For every winner, there are many that never come back. Chasing cheap stocks without a margin of safety is more like gambling than investing. A better approach is to focus not on how cheap a stock is, but why it's cheap, and whether the reasons are likely to change. Long-term investing is often held up as the gold standard of financial wisdom. It's what seasoned investors recommend. It's backed by decades of data showing that staying invested through ups and downs leads to better results. Compound growth takes time, and markets tend to reward patience. But despite this, most investors behave in ways that are shaped by short-term noise. They check prices daily. They panic during market dips. They chase trends and headlines. They say they're in it for the long haul, but they act as if every week is the end of the game. This is the long-term versus short-term paradox. Investors claim to think long-term, yet most of their actions are driven by short-term reactions. This paradox begins with how people experience risk. Long-term investing works best when you ignore short-term movements. But markets are noisy. Stocks rise and fall every day. Financial news runs 24/7. Social media pumps out opinions, predictions, and panic. When you're constantly exposed to this stream of information, it's hard not to react. A portfolio that dropped 20% over a month doesn't feel like a minor blip in a decades-long plan. It feels like something is wrong. The emotional response kicks in. Sell before it gets worse. Consider a retirement investor with a 30-year horizon. They hold a diversified index fund. Historically, this kind of investment delivers reliable returns over time, despite occasional downturns. The plan is to keep adding money each year and not worry about market fluctuations. But 1 year into the plan, a recession hits. The market drops 25%. Headlines warn of a financial crisis. The value of the portfolio falls sharply. The investor starts to second-guess everything. What if this isn't just a dip? What if the market won't recover this time? The plan was long-term, but the reaction is short-term. They sell. This kind of behavior is common. Data from brokerage platforms shows that most individual investors underperform the very funds they invest in. This is not because the funds are bad. It's because investors jump in and out at the wrong times. They buy after prices rise. They sell after prices fall. They react to short-term movements, trying to time the market, even when they claim to be in it for the long term. The paradox is also reinforced by the structure of the financial industry. Fund managers are evaluated on short-term performance. They have to show quarterly results. If they underperform for even a few quarters, they risk losing clients or their jobs. This pressure leads them to make short-term decisions, even when they know the long-term view would be better. The same applies to media. Financial news outlets don't thrive on long-term thinking. They thrive on drama, volatility, and daily updates. A headline saying, "Stay the course for 20 years," doesn't get clicks. Market crash incoming does. Even the tools investors use encourage short-term thinking. Mobile trading apps put market data at your fingertips. You can watch your net worth change minute by minute. The easier it is to check, the harder it is to ignore. This instant access increases anxiety. Investors become more focused on what their portfolio is doing today rather than what it will do over a decade. There's also a psychological element. Long-term goals feel abstract. Retirement is far away. College funds take years to grow. But a market loss today is real and painful. Behavioral finance calls this loss aversion. The idea that losses hurt more than equivalent gains feel good. So when the market drops 10%, investors feel a strong emotional urge to act, even if the best move is to do nothing. Markets themselves are built on the tension between short-term volatility and long-term trends. In the short term, prices reflect emotions, news, and speculation. Over time, they reflect business fundamentals, earnings, and economic growth. A company's stock might fall because of a rumor, even if its long-term prospects are strong. Or it might rise on hype, even if it's not profitable. The investor who focuses on the short term sees noise. The one who focuses on the long term sees value. Warren Buffett has talked about this paradox often. He says the stock market is designed to transfer money from the impatient to the patient. But patience is hard. It means watching your investments fall without reacting. It means holding boring assets while others chase trends. It means sticking to a strategy even when it feels uncomfortable. Most people know this intellectually, but emotionally they struggle. A classic case of this paradox came during the 2020 pandemic. In March, markets crashed. Investors fled for safety. Some sold at the bottom. But just a few months later, markets had recovered. By the end of the year, many indexes had made new highs. The investors who stayed put saw their portfolios rebound. The ones who sold locked in losses. The event revealed who truly had a long-term mindset and who only thought they did. Another layer of the paradox is how people define long-term. For some, it means 3 years. For others, it means 30. But real long-term investing means decades. It means accepting that in any given year, your investments might go down. It means understanding that there will be recessions, corrections, and panics. And it means preparing for that emotionally and financially. There are ways to resolve the paradox, but they require discipline. One approach is to automate investing. Set up regular contributions to a long-term portfolio and don't look at it often. This removes emotion from the equation. Another is to define your investment horizon clearly and align your strategy with it. Money needed in the next few years should not be in stocks. That's for long-term capital. Having a buffer prevents short-term needs from disrupting long-term plans. Investors can also benefit from reframing how they view volatility. Instead of seeing downturns as threats, see them as expected. Market declines are not interruptions. They are part of the process. Every long-term chart of market growth includes major drops. But over time, the general direction is up. Staying invested through these periods is what creates wealth. The long-term versus short-term paradox is ultimately about behavior. Most people understand what works in theory. Buy good assets, hold them, avoid panic. But their instincts push them in the opposite direction. They crave action. They fear loss. They react to noise. And in doing so, they undermine their own goals. To be a successful investor, one must not only choose a sound strategy, but also resist the urge to knowledge is power. That's the idea we've been taught since childhood. The more you know, the better your decisions. The better your decisions, the better your outcomes. In theory, access to more information should make you more accurate, more precise, more capable. But in practice, there's a twist. More information often gives the illusion of understanding without delivering actual insight. It leads to confidence without accuracy. That's the knowledge paradox. The more people know, the more confident they become, even when their decisions aren't improving. The human brain craves certainty. When it receives new information, especially if that information appears detailed or technical, it often interprets that as deeper understanding. But not all information is equal. Some is noise, some is contradictory, some is completely irrelevant. Yet once it's absorbed, it still affects our perception of how much we think we know. This leads to overconfidence, even when the data is misleading or misunderstood. Take investing. A beginner reads a few articles about market cycles, studies some charts, and listens to a podcast or two. Suddenly, they feel prepared. They've seen historical returns, learned some jargon, maybe even watched a few videos on technical analysis. The data is flowing, and with it comes a sense of control. They make trades based on patterns they think they recognize. When one or two work out, it confirms their new confidence. But what they don't see is the vast field of knowledge they've yet to encounter: macroeconomic shifts, hidden correlations, behavioral traps, liquidity risks. Their small slice of knowledge gives them just enough confidence to make big mistakes. This is common in any domain where decisions are complex and outcomes are uncertain. In medicine, a patient might read about their symptoms online. They see a few possible conditions listed and decide which one fits best. They then question a doctor's diagnosis, convinced by the volume of material they've read. But volume is not depth. The information may be accurate, but without the context, experience, and training to interpret it properly, it can lead to the wrong conclusion. Worse, it can lead the patient to dismiss expert advice entirely. In the legal world, This plays out when people try to represent themselves in court. They read laws, watch courtroom shows, maybe even look at a few cases online. They come in confident, thinking they understand how the system works. But law is about precedent, strategy, and subtle interpretation. What seems clear on paper often plays out very differently in a real legal proceeding. Their newfound knowledge gives them a false sense of readiness. The paradox deepens in the information age. Today, knowledge is abundant. You can look up anything, anytime. You can get data, context, commentary, and analysis within seconds. But more doesn't mean better. In fact, the easier it is to access information, the less effort we put into filtering it. We absorb facts without asking how reliable they are. We confuse repetition with truth. And the more we absorb, the more certain we feel, even when the information is shallow or biased. Cognitive science shows this clearly. People often mistake familiarity for understanding. If you hear a concept repeatedly, you begin to feel like you grasp it, even if you've never tested that knowledge or applied it. This is called the fluency effect. It makes people rate their understanding higher than it actually is. As a result, people often make poor decisions with high confidence. They don't second-guess themselves because everything feels familiar. This leads to mistakes that wouldn't occur if they had less information and more humility. This overconfidence isn't just personal. It plays out in institutions and policy decisions as well. A government agency receives more intelligence reports than ever before. Data flows in from satellites, analysts, sensors, and third-party sources. But instead of clarity, this flood of information leads to conflicting signals. Decision-makers rely on fragments they understand or that support their beliefs. They become overconfident in a flawed interpretation because they're surrounded by data. The sheer weight of information gives them the illusion of thoroughness. But information without structure is just clutter. In teams and organizations, the paradox leads to groupthink. Each person brings in different data points. The group discusses them, and everyone leaves the meeting feeling more informed. But often, instead of challenging assumptions, they align around the most confident speaker or the consensus opinion. The illusion of shared knowledge leads to action, but not always to better results. The team believes they've covered the issue because so much was said, yet the most important questions were never asked. The Dunning-Kruger effect also ties into this paradox. People with limited knowledge in a domain tend to overestimate their competence because they don't know what they don't know. They haven't yet learned enough to see the complexity. As knowledge increases, people go through a phase where they lose confidence. They see how much more there is to understand. True experts, oddly enough, are often less confident in their predictions because they're aware of all the variables. In contrast, those with partial knowledge feel emboldened. Think of someone who has just learned about nutrition. They read a few studies and now swear by a specific diet. They become evangelists, convinced they've found the truth. But actual nutrition science is messy. It changes with new evidence. It varies by individual. A trained nutritionist might be cautious and flexible, recognizing exceptions and nuances. But the new enthusiast, armed with limited but loud information, is rigid. More knowledge has made them less open-minded. This paradox plays out in hiring as well. A manager reads multiple resumes, sits through interviews, and uses software to screen candidates. They gather more data than ever before. But the flood of information can lead them to overweight unimportant signals, like the name of a university or how confidently someone answers a question. They may skip the quiet candidate with more substance in favor of the polished speaker who tells them what they want to hear. They feel more confident in their choice, but the data didn't help them make a better decision. Even in everyday life, the knowledge paradox shapes how we see ourselves. A company reports record earnings. Revenue is up. Profits are higher than ever. Margins are strong. Operating costs are under control. The business is growing in all the right places. And yet, the stock drops. To someone unfamiliar with the way markets actually behave, this seems irrational. Shouldn't strong earnings push the price up? If a company is doing well, shouldn't investors reward it? This is where the earnings paradox comes in. Stock prices don't rise or fall simply because of a company's earnings. What matters more is how those earnings compare to what investors expected. A company can report strong numbers on paper and still see its stock price drop if those numbers came in below forecasts, or if guidance suggests slower growth ahead. On the other hand, a company can report lower earnings than the previous quarter and see its stock rise, if those results beat what investors feared. In this way, expectations shape the market far more than actual results. Investors don't trade on today's numbers. They trade on their beliefs about the future. That includes forecasts, guidance, economic indicators, competitive positioning, and sentiment. If a company reports that its earnings are up 10% year over year, that might sound good. But if analysts were expecting 15%, the market reacts with disappointment. The earnings, in absolute terms, are strong, but relative to expectations, they are weak. This dynamic plays out every quarter in the earnings season. Analysts issue estimates. The company issues guidance. Investors try to anticipate whether the company will beat or miss those targets. A beat means actual results exceeded expectations. A miss means they fell short. Even a tiny miss can lead to a big drop in share price. It's not about the raw performance, it's about how that performance compares to what the market priced in. Consider a tech company that just posted a 20% increase in earnings. Revenue grew. User numbers are up. But if the company had hinted at 25% growth in previous guidance, or if Wall Street analysts had forecast higher earnings, the stock might tumble. Investors had already baked in that higher figure. When reality came in below that level, even if it was still positive, market sentiment shifted. Disappointment, not celebration, followed. In that moment, perception outweighed performance. This paradox becomes even clearer when looking at high-growth companies. These businesses often trade at high price-to-earnings ratios because investors expect rapid growth. The valuation already assumes big future earnings. When those companies report results, they have to do more than just perform well. They have to outperform sky-high expectations. If growth slows even slightly, the stock can plunge. Investors didn't just buy the company's current performance. They bought a vision of explosive growth. Anything that threatens that vision hits hard. Tesla is a classic example. Over the years, it has reported strong earnings and impressive delivery numbers. But the stock has still swung wildly depending on guidance, future delivery estimates, and comments from leadership. When expectations are built around exponential growth, even a modest slowdown, despite solid earnings, can lead to sell-offs. Investors who bid up the price based on future scenarios reevaluate when new data suggests those scenarios may not play out as hoped. In contrast, companies with low expectations have more room to surprise. A struggling retailer might report a small profit after a string of losses. Analysts expected another loss, so the news is a pleasant surprise. The result? The stock price jumps. The actual earnings are worse than many other companies in the same sector, but relative to expectations, it was a success. This makes investing counterintuitive. Good news doesn't always mean rising prices. Bad news doesn't always mean declines. The market constantly adjusts prices based on expectations and then readjusts them when new information comes in. This is why you'll sometimes see a company post a loss and rally 15%, while another posts record profits and drops 10%. One beat expectations, the other missed. There's also a forward-looking element that adds to the complexity. A company might report excellent past performance, but if it issues weak guidance for the next quarter, investors react to the warning, not the history. Markets are discounting mechanisms. They value what lies ahead, not what's behind. That's why earnings calls are so closely watched, not just for numbers, but for language. If a CEO says, "We expect slower growth in the second half of the year," that comment can overshadow a great quarter. Forward guidance has more weight than current figures. This explains why volatility often increases after earnings reports. It's not the data itself, it's the interpretation of that data relative to what was assumed before. Investors constantly ask, was this better or worse than we thought? And that question drives price movements. This also highlights why earnings estimates play such a crucial role. Analysts set targets. Those targets shape investor expectations. When a company beats those estimates, the market sees it as a signal of strength. When it misses even slightly, it's seen as a red flag. But those estimates are not always grounded in reality. They're often speculative, and yet they guide behavior. A company's stock might rally simply because it beat by a penny, even if the broader picture is unchanged. This shows how expectations can detach from fundamentals. The paradox is reinforced by short-term traders who thrive on these earnings beats and misses. They aren't interested in holding for the long term. They're playing the game of reaction, trying to get ahead of the market's response to earnings surprises. Their trades amplify price swings. This contributes to the mismatch between earnings strength and stock performance. The market isn't rewarding the company. It's reacting to the surprise. Earnings themselves are not the sole driver of stock prices. They are just one piece of a larger picture that includes guidance, macroeconomic factors, sector trends, and investor sentiment. A strong quarter can be overshadowed by rising interest rates, geopolitical uncertainty, or weakness in other companies within the same industry. Investors don't operate in a vacuum. They make decisions based on a complex web of influences, of which earnings are only one part. This doesn't mean earnings don't matter. Over the long term, they do. Companies that consistently grow earnings tend to see their stock prices rise. But in the short term, especially around earnings season, it's the delta between buy and hold is one of the most praised investment strategies. It's simple. You pick quality assets, usually broad index funds or strong individual stocks, and hold them for the long term. You don't time the market. You don't jump in and out. You just stay the course. Over decades, the historical data supports it. Markets tend to go up over time. Compound growth does the heavy lifting. Transaction fees are minimized. Taxes are deferred. Volatility gets smoothed out. The longer the timeline, the more buy and hold seems unbeatable. But there's a catch that doesn't show up in charts or backtests. You actually have to hold through everything. And that's where most investors break. The buy and hold paradox is that the strategy works on paper, but most people can't follow through when it matters most. It's not hard to buy. It's not even hard to hold when times are good. The real test comes during brutal downturns, when everything in you screams to sell. The numbers drop. The news turns dark. Your portfolio bleeds red. In those moments, the plan feels foolish. You tell yourself this time might be different. That holding isn't discipline. It's denial. Consider the 2008 financial crisis. The S&P 500 lost more than 50% from its peak. Over the course of about 17 months, the market plunged. Lehman Brothers collapsed. Banks failed. Real estate crashed. Headlines warned of another Great Depression. In that environment, holding a stock portfolio didn't feel brave. Felt reckless. Investors who stuck to buy and hold saw their wealth cut in half. And for many, that was too much. They bailed out. They sold at the bottom. They missed the recovery. Those who truly held through the storm, without selling, without hedging, without flinching, eventually came out ahead. The market recovered. Dividends resumed. Compound interest kicked back in. But to get there, they had to endure panic, doubt, and the appearance of ruin. The strategy worked, but it demanded something most people couldn't give: emotional resilience under fire. A similar story unfolded during the COVID-19 crash in early 2020. The market fell 30% in about a month. That speed was terrifying. Travel stopped. Cities shut down. The economy stalled. Investors faced a fast, steep drop with no clear sense of how bad things would get. Some sold early. Others sold at the bottom. But the market snapped back almost as fast as it fell. Those who sold had to decide when to get back in, and most didn't do it in time to catch the recovery. Once again, buy and hold worked for those who could actually hold. The paradox is amplified by how we experience loss. Losses hurt more than gains feel good. This isn't theory, it's behavioral psychology. A 30% drop in your portfolio doesn't just register as a financial event. It's emotional, feels like failure, causes stress, and when it happens quickly, it creates panic. Investors in those moments aren't thinking about 30-year charts. They're thinking about the money they might never get back, the plans they'll have to delay, the safety they thought they had but don't feel anymore. Buy and hold requires investors to do the opposite of what their emotions tell them. It asks for conviction when doubt is everywhere. It asks for calm in the middle of chaos. And it asks for faith in a future that seems uncertain. That's why the strategy works, because it's hard. The rewards come to those who can wait, but more importantly, to those who can endure. It also asks for a level of financial stability that not everyone has. Holding through a downturn is easier when you don't need to sell. If your job is secure, your bills are covered, and your emergency fund is full, then a bear market is a paper loss. But if you lose your income, or if you face unexpected expenses, you might be forced to sell at the worst time, not because of panic, but because of necessity. That's not an emotional failure. It's a structural risk. It shows that buy and hold also depends on external stability, not just internal discipline. Even among those who do have the ability to hold, few prepare for the pain of it. They read about 7% average returns and assume the path will be smooth. They imagine compounding like a staircase, but the market doesn't move like that. It surges, stalls, crashes, recovers, repeats, tests conviction. Long-term investors are guaranteed to face multiple bear markets. Each one will feel like it might be the last. Each one will come with headlines saying this time is different. And each time, the right move will still be to hold, if the underlying strategy and holdings remain sound. Buy and hold also becomes more difficult in a culture of immediacy. We're trained to expect quick results. News cycles are fast. Social media amplifies every dip and spike. We check our accounts daily, even when we say we're long-term investors. Every small loss becomes a signal. Every headline adds to the noise. In that environment, holding for decades requires not just strategy but silence, an ability to tune out short-term distractions and remember the actual timeline you committed to. That timeline matters. Buy and hold only works if you give it time. If you plan to hold for 5 years, you're not really using the strategy. That's still within the window of short-term market cycles. Real buy and hold is 10, 20, 30 years. It's the strategy for retirement accounts, for legacy planning, for building generational wealth. And that long arc makes the downturns survivable. Over 30 years, even a 50% crash is a dip, not a disaster. But over 3 years, it feels like a catastrophe. Most investors think they're long-term until the short-term pain shows up. Time is what makes the strategy work. But time alone isn't enough. You need the psychological strength to stick with it. That's the hidden cost of buy and hold. It's not about intellect. It's not about financial modeling. It's about temperament. It rewards those who can delay gratification, withstand discomfort, and ignore the herd. And even then, the paradox stays sharp. The more you know how well buy and hold works, the harder it becomes to watch others succeed with risky trades in the short term. When a meme stock doubles overnight or a speculative bet pays off, long-term, every investor wants alpha. It means outperforming the market, beating the benchmark, doing better than the average. It's the goal behind most active strategies. Fund managers chase it. Hedge funds market it. Individual investors hope for it. Alpha is the prize for being right when others are wrong, for spotting what others miss, for taking smart risks and reaping the reward. But here's the problem. The market is made up of investors. It is not some separate machine to be outwitted. It's the average of all decisions made by everyone putting money in. And most people, by definition, can't beat the average. For every investor who earns alpha, another must lag behind. That's the alpha paradox. Everyone wants to outperform, but together they are the market. The average return is the benchmark, and you can't all be above average. This truth is uncomfortable, especially for professionals. If a mutual fund manager earns 2% above the S&P 500, someone else must have underperformed by 2% to balance the scale. The stock market doesn't produce alpha on its own. It produces returns, some years better, some worse. Alpha is relative. It's performance above that average. So for one investor to gain an edge, another must unknowingly give one up. This becomes even clearer when you factor in fees. Active managers charge more. That higher cost must be justified by better performance. But over time, The numbers show that most active funds don't outperform their benchmarks once fees are included. Some do, especially in short periods. But across 10 or 20 years, the majority fall short. The data from Spiva S&P indices versus active reports this regularly. A small minority of active managers outperform consistently, and their identities often change. Past winners don't stay winners. For the average investor, this means that chasing alpha is more likely to lead to disappointment than success. You're not just trying to beat the market. You're trying to beat other investors, the ones who have more information, better tools, faster access, and often more experience. They aren't just guessing. They're pricing in every bit of news, every signal, every whisper of data. By the time you make a move based on a headline, it's already reflected in the price. The market has moved. Your edge is gone. That's not to say alpha doesn't exist. It does, but it's scarce, and it's not evenly distributed. A few investors achieve it by being early, being disciplined, or having an actual informational advantage. Some find it through behavioral consistency, doing the right thing when others panic. Others find it through deep contrarian research, but for everyone who finds it, many more believe they have it and don't. The market humbles them over time. Consider a simple example. Imagine 10 investors. Each one believes they can beat the market. Each one has a strategy, a thesis, a reason to believe they'll do better than the average. But only one can be at the top. If 3 beat the average, the other 7 must fall below it. The group as a whole is the average. That's inescapable. No amount of ambition or confidence changes the math. The market is a zero-sum game before costs, and a negative-sum game after costs. This paradox is hidden when markets rise. When almost everyone is making money, it's easy to think you're doing well. If your portfolio is up 12% and the S&P is up 10%, you pat yourself on the back. You believe you've found an edge. But if the S&P is up 25% and you're up 12%, you feel like you failed even though your portfolio grew. Your perception of success changes based on what others are doing. That's the nature of alpha. It's not about making money. It's about making more money than someone else. This mindset can lead to reckless behavior. In the pursuit of alpha, investors often take on more risk than they understand. They chase hot sectors. They rotate strategies. They follow stories, tips, and short-term trends. The desire to outperform pushes them into trades they don't fully grasp. When markets turn, they're left exposed. The irony is that trying to beat the market often leads to underperformance. The more aggressively you chase alpha, the harder it becomes to catch. The paradox also explains the rise of passive investing. If most active strategies fail to beat the market after fees, then the logical choice is to accept the market return. That's what index funds offer. They don't seek alpha. They mirror the benchmark. And over time, they tend to outperform most actively managed funds. Not because they're smarter, but because they're cheaper, more consistent, and not subject to behavioral traps. Passive investors aren't trying to win. They're trying not to lose. And that turns out to be a better long-term strategy for most. Still, the allure of alpha persists. Investors don't just want average. They want to be above average. They want to win. It's an emotional goal as much as a financial one. That's why you'll always see new funds, new strategies, and new promises of outperformance. But the paradox remains. Everyone can't be above average. For one person to get alpha, another has to miss it. The more people chase it, the harder it is to find. It's worth noting that alpha, when it does appear, often comes from sources that don't look like genius in the moment. It can come from being patient during downturns, or from ignoring fads. It can come from buying when others are fearful and holding when others are greedy. These aren't glamorous strategies. They're quiet. They require doing nothing when others are doing everything. But that's where long-term edge often lies, not in prediction, but in discipline. This paradox should humble investors. It doesn't mean you should give up trying to improve your returns, but it does mean you should understand the odds. Alpha is hard to...
A woman buys a lottery ticket on a whim. She doesn't usually play, but something nudges her that day. She picks random numbers, birthdays maybe, or just digits she likes. A few days later, she sees the winning numbers on the screen. They match, every single one. She's stunned. People around her call it fate, a miracle, a sign. But as the excitement builds, a deeper question slips into the background. How unlikely is this really? And what does it mean to say something this rare just happened? This is the lottery coincidence. It's the tension between probability and personal meaning. The odds of winning a large lottery like Powerball are often around 1 in 292 million. That's an almost unimaginably small chance. It's less likely than being struck by lightning multiple times. When someone wins, it feels extraordinary. But lotteries are played by millions. With that many people participating, someone almost always wins eventually. The rare event happens often, just not to most people. Now imagine that someone wins the lottery twice, not in the same week, but maybe 10 years apart. It happens rarely, but it has happened. When it does, people gasp. They say it must be rigged, or that the person is lucky beyond belief. But again, scale matters. If enough people play, and they play often, then rare things become expected over time. Suppose you flip a coin 20 times. You don't expect all heads. That has a 1 in a million chance. But flip coins billions of times, and you'll see it occasionally. The same logic applies to lottery coincidences. They're rare by design, but not impossible. The more you look, the more you find. This raises a problem with how people understand chance. We treat unlikely events as meaningful. If a man dreams of numbers and then wins using them, the dream feels prophetic. But millions of people have strange dreams. Some buy tickets, most lose, one wins. The dream wasn't special until the outcome happened. Then memory highlights it. All the other dreamers who didn't win fade from view. This is selection bias. We notice the hit, we forget the misses. The same pattern appears in other coincidences. You think of an old friend, moments later they call. It feels magical, but you've thought of hundreds of people who didn't call. You only remember the match. This is confirmation bias. The mind connects dots after the fact and gives them weight. Now back to the lottery. A man wins using the same numbers every week for 30 years. He says he always believed they would come through. Eventually they do. He feels vindicated. But imagine the same man losing every week until he dies. That story never makes headlines. It's the same behavior, different outcome. The coincidence only seems deep when it hits. People also misunderstand randomness. True randomness includes patterns. If you simulate 1 million lotteries, you'll get repeating numbers. You'll get clusters. That doesn't mean the system is broken. It means chance behaves in strange ways. It doesn't avoid pattern, it includes it. But when people see a pattern, they assume there's a reason. That's pattern seeking, one of the brain's strongest habits. Take another example. A woman wins the lottery on her birthday. The numbers match her birth date. It feels personal, but dates are common. Numbers from 1 to 31 show up on tickets all the time. If enough people play, some will win on birthdays. It's not a miracle. It's a product of the scale, but to her, it feels like the universe spoke. That's the heart of the coincidence, personal meaning in public randomness. A lottery ticket is mass-generated. Millions of people play. But when someone wins with a number that feels important, an anniversary, a child's age, it transforms. The randomness turns into story. The brain loves story. It needs it to organize the world. Some go further. They treat the win as a sign. They change careers, start new ventures, reconnect with people. The coincidence becomes a turning point. Not because of the odds, but because of how it feels. And that's real. The emotion is genuine, but the cause is misunderstood. The event was random. The story was layered on top. The mind doesn't like that. It wants cause. It wants purpose. Saying it just happened feels hollow. So it builds reasons. It says, I knew it, or it was meant to be. These are not logical. They're emotional tools. They protect us from the discomfort of chaos. But understanding the lottery coincidence means holding both sides at once. It was astronomically unlikely, but someone had to win. It feels personal, but it was impersonal. It means everything to the winner, but in the math, it means nothing. That's the split, the paradox, the rare event that's inevitable over time. In philosophy, this leads to questions about probability and explanation. If something has a 1 in a billion chance and it happens, does that mean something caused it? Not necessarily. Rare events happen every day in large enough systems, but we want them to mean more. That desire creates superstition. Or conspiracy or magical thinking. People say, it can't be chance. but often it is, because chance on a large scale guarantees surprise. Think of it like this. You walk through a forest and find a stone shaped like a heart. You say, "What are the odds?" They're small, but there are trillions of stones. One was bound to look like something. You found that one. The odds of finding it were low. The odds of someone finding something were high. That's how randomness works. The lottery is a perfect mirror for this. It's structured randomness. It generates winners, but not meaning. The meaning comes from us, from the stories we tell after, from the way we link a number to a memory, from how we turn math into magic. And sometimes the coincidence feels so precise it breaks logic. A man plays his late father's favorite numbers and wins on the anniversary of his death. It sounds scripted, but again, memory only keeps the match. All the near misses vanish. All the times he played and lost don't make the story. Only the moment it works gets remembered. The brain edits the past to fit the win. This doesn't mean the coincidence is worthless. It just means it's human. The odds are real. The event is rare. But the meaning, that's yours. It's not in the ticket. It's in the telling.
Compounding is simple. You earn returns not just on your original investment, but on the returns you've already earned. Over time, the gains build on themselves. $1 becomes 2, then 2 becomes 4, then 4 becomes 8. The longer you leave it, the faster it grows. On paper, it looks effortless. Invest early, stay invested, and wealth builds slowly at first, then explosively later. But there's a problem. Most of the rewards come after most people lose patience. This is the time paradox. The power of compounding works best when you give it time, yet the human tendency is to quit before the real payoff begins. People understand compounding in theory. They've seen the graphs. They've heard the stories about Warren Buffett making most of his fortune after turning 60. They nod at the idea that time in the market beats timing the market. But in practice, compounding feels unrewarding for years. The early gains are so modest they barely register. A $5,000 investment growing at 7% per year becomes $5,350 after 1 year. After 2 years, it's $5,724. That doesn't feel like wealth creation. It feels like watching paint dry. Most people want to see results fast. If they're investing monthly, they check their account and wonder why it's not moving much. They question the strategy. They compare it to someone who took a risk and doubled their money overnight. They consider switching. They feel like they're falling behind, so they stop, or they chase something else. They interrupt the process just when it's starting to work. That's the trap. Compounding is backloaded. The early years look unimpressive. The real acceleration comes much later. You might invest for 10 years and feel like nothing's happening. Then in year 15 or 20, the numbers suddenly jump. It's not that the investment changed. It's that time did its work. But you only get there if you stay the course long enough to see it. Take an example. Say you invest $10,000 at 7% annual returns. In 10 years, you'll have just under $20,000. Not bad, but hardly life-changing. Now let it sit for 30 more years without touching it. That $20,000 becomes nearly $150,000. Most of the gains, more than $130,000, came after the first decade. The final years are where the real growth shows up. And that's the paradox. The greatest rewards come at the point where most people would have already stopped watching. Buffett's wealth is often used to illustrate this. He's widely respected for his skill, but the real driver of his fortune is how long he's been investing. He bought his first stock at age 11. He's still investing well into his 90s. That's over 80 years of compounding. Most of his net worth came after he turned 50, not because his returns improved, but because time finally caught up to the math. But holding that long is hard. Life gets in the way. You lose your job. You need the money for a down payment. The market drops and fear takes over. You read an article that questions the whole strategy. You see someone else getting rich quick. All of these pressures make it difficult to wait long enough for compounding to work. The strategy is simple. The execution isn't. Even worse, modern culture encourages impatience. Everything is faster now. Food, information, communication. We get answers instantly. We expect feedback quickly. So when an investment doesn't perform in a few months or even a few years, we question it. Social media magnifies this. Someone posts their winning trade. Another shows off their new car bought with crypto gains. Your slow-growing index fund feels foolish in comparison. You start to wonder if compounding is just a myth. It's not. It's just slow. This is why most people don't build wealth through compounding, even though the math is available to everyone. It requires consistency without reward. It requires trust in something you can't feel yet. It demands that you ignore distractions, headlines, and even your own instincts. It asks you to do less, not more. That's difficult in a world that rewards action. People often make the mistake of trying to accelerate compounding. They think they can jumpstart the process by chasing higher returns. They move from a 7% fund to something promising 20%. Sometimes it works. Usually it doesn't. They end up losing money, resetting the clock. Every detour delays the effect. Every withdrawal steals from the future. Every restart means starting small again. That's another part of the paradox. You can't rush compounding. You can't hack it. You can't push it into high gear by throwing money at it or trying harder. It follows its own pace. You either give it time or you don't benefit. It's like planting a tree. Watering it 5 times a day won't make it grow faster. It grows at its own speed. What matters is not the intensity of your effort, but the consistency of your patience. Some investors don't quit entirely. They just pause. They take breaks. They skip contributions for a few years. They dip into their accounts for vacations or new gadgets. Feels harmless, but even small disruptions can cost huge amounts over time. The missing years at the start matter more than you think. A person who invests $5,000 per year from age 25 to 35 and then stops entirely will often end up with more money than someone who starts at 35 and contributes for the next 30 years. That's how front-loaded compounding is. Time matters more than amount. This also affects retirement planning. Many people delay saving until their 40s. They tell themselves they'll make up for it later. But by then, they've missed the most powerful years of compounding. Even doubling their contributions may not catch up. The early years aren't just helpful, they're essential. They lay the foundation. Once lost, that time can't be recovered. The same principle applies outside of finance. Skill development, careers, relationships, all of them benefit from compounding. Small habits repeated over time lead to outsized results. A person who reads 10 pages a day may not seem different at first, but after 10 years, they've read hundreds of books. The gains come late. The visible benefits trail the invisible effort. And because they come late, many give up early. That's what makes compounding feel unfair.
A teacher tells her students they will receive a surprise gift next week. She adds a condition. The gift will arrive on one day, Monday through Friday, and it will be unexpected. That means the students won't know in advance which day the gift will come. At first, this sounds exciting, a pleasant surprise. But then a student starts to think it through. They say, it can't be Friday, because if it hasn't arrived by Thursday evening, we'll know for sure it must come on Friday. And if we know it must come on Friday, then it won't be a surprise. So they eliminate Friday. Now they think about Thursday. If the gift hasn't arrived by Wednesday night and we've already ruled out Friday, then Thursday becomes predictable. It would have to come Thursday. But that means it wouldn't be a surprise either. They cross off Thursday. The logic continues backward. Using the same reasoning, they eliminate Wednesday, Tuesday, and finally Monday. By the end of their analysis, they've ruled out every day. They conclude the surprise gift can't happen at all. But then on Wednesday, the gift arrives. The students are surprised. That's the unexpected gift paradox, also known as the paradox of the surprise exam. It's a logical puzzle that creates tension between reasoning and reality. The student's logic says the surprise is impossible, but when the gift actually comes, they're surprised anyway. The paradox lives in the space between what logic predicts and what actually occurs. This contradiction arises from how we define surprise. In the teacher's statement, the surprise must come on a day when students don't expect it. But if they apply deduction perfectly, they seem to eliminate all options. Yet the surprise still happens. So either the logic is flawed, or the definition of unexpected is flawed. Something in the reasoning breaks down. Let's look more closely at the assumptions. The students believe that if they can predict the gift will come on a certain day, then the gift can't be a surprise. That's fair. If someone says you'll get a surprise on Tuesday, and you're told that on Monday night, then Tuesday's gift won't be unexpected. So the logic hinges on what counts as knowing. If the students can eliminate Friday based on the assumption that they'll know it must come that day, then Friday can't be the surprise day. But in eliminating Friday, they change their expectation. Now they expect it earlier. This change ripples through the week, collapsing every day into a contradiction. But something strange happens when you look at how humans actually think. The backward reasoning sounds airtight in theory, but in practice, few people follow it. Most expect the gift on Wednesday or Thursday, and when it comes, they're surprised, even if they'd previously tried to predict it. That shows the limits of perfect deduction in messy, real-world minds. Philosophers and logicians have analyzed this paradox in depth. Some argue the reasoning fails because it assumes that knowledge is static. That is, it treats the student's future beliefs as fixed, even though each day brings new information. Others say the paradox results from a misuse of self-reference. The teacher's statement includes a condition about the student's knowledge. You won't know the day, which creates a loop. The statement talks about itself in a way that breaks clean logic. This is similar to the liar paradox, where someone says, "This sentence is false. If it's true, then it's false. If it's false, then it's true." Both paradoxes involve statements that loop back on themselves. In the gift case, the paradox comes from the idea that the gift will come when you least expect it, but once you expect not to expect it, the logic collapses. Another angle is the difference between first-order and second-order beliefs. A first-order belief is, the gift will come on Thursday. A second-order belief is, I believe I will believe the gift will come on Thursday. The paradox involves this second layer. It's not about whether the gift comes. It's about whether you expect to expect it. That recursive thinking is where the confusion grows. Imagine a similar situation. A guard tells a prisoner they'll be released one day next week, but they won't know in advance which day. The prisoner thinks through the week, eliminating each day just like the students. But then they're freed on Tuesday and are genuinely surprised. Their logic said the release couldn't happen. Reality proved otherwise. This highlights something important. Human surprise isn't bound to perfect deduction. We get distracted, we forget, we second-guess ourselves. Even if we eliminate Friday from our list, we might still be caught off guard if the gift arrives then. The mind doesn't hold all possibilities in perfect order. That's why the paradox seems airtight in theory, but fails in practice. Some say the paradox teaches humility. It shows that logic, while powerful, can't capture every aspect of belief and expectation. Others say it exposes how language can mislead us. When we say unexpected, what do we mean? Unexpected to whom? At what point? If the students guess Tuesday and it comes Tuesday, does that ruin the surprise? Or was the surprise never promised in the first place? There's also a game theory aspect. Suppose the teacher knows the students will overthink the problem. She lets them eliminate days. Then, when they've ruled out Wednesday, she delivers the gift on Wednesday. She uses their expectation against them. This turns the paradox into a trap, one where overthinking prevents belief in a real event. In literature, this kind of twist appears in stories with prophecies. A prophecy says a king will die on a day he least expects. He takes precautions, avoids danger, becomes paranoid. Then he relaxes on a quiet day and is killed. The prophecy was true, not because it foretold fate, but because it shaped behavior. The surprise didn't come from the day itself. It came from how the king calculated his safety. The unexpected gift paradox reminds us that time, belief, and knowledge are more fluid than logic admits. In theory, perfect deduction should remove all surprise. In reality, surprise still finds us. The mind's effort to outthink a simple promise ends up outthinking itself. And when the gift finally appears on a Wednesday morning maybe, or late Tuesday afternoon, it feels like a gift, not because it breaks the rules, but because it cuts through the tangle and lands where thought can't reach.
Interest rates are the price of borrowing money. When central banks cut them, they make it cheaper to take on debt. This is meant to encourage spending, investing, and hiring. Businesses borrow to expand. Consumers borrow to buy homes and cars. Investors shift money into riskier assets. Lower rates grease the gears of the economy. In a slowdown, they are a lifeline. They help turn recessions into recoveries. That's the theory. But there's a problem. Cheap money doesn't just help the real economy. It also pours into financial markets. It drives up the price of stocks, real estate, and anything else people believe will hold value. Over time, this can inflate dangerous asset bubbles. That's the interest rate paradox. Rates are lowered to boost growth, but those same low rates can distort markets and create new risks. After the 2008 financial crisis, central banks around the world slashed interest rates. The Federal Reserve dropped its benchmark rate to near zero. The goal was to stimulate recovery. People had lost jobs. Lending had frozen. Confidence was gone. Low rates were meant to restore demand. They worked. Slowly, the economy picked up. But something else happened too. Stocks entered a historic bull market. Real estate rebounded. Bond yields fell, pushing more investors into equities. Riskier assets surged in price. This wasn't a coincidence. When safe assets like savings accounts or government bonds offer almost nothing, people search for return elsewhere. They buy stocks even if prices are high. They invest in real estate even if yields are low. They chase returns wherever they can find them. That demand pushes prices up. And as prices rise, more investors jump in, afraid of missing out. The dynamic feeds on itself. The market no longer reflects just company earnings or property value. It reflects the artificial influence of cheap credit. The real danger is that these bubbles often look like success at first. Rising asset prices create a wealth effect. People feel richer. They borrow more. They spend more. This supports short-term growth, which reinforces the decision to keep rates low. But underneath, imbalances grow. People take on more leverage. Investors take on more risk. Valuations stretch further from fundamentals. And when the tide turns, when rates eventually rise, or when confidence cracks, the fall can be sharp. The housing market is a clear example. After 2008, interest rates stayed low for years. Mortgage rates dropped. Monthly payments became more affordable. That helped homebuyers and lifted the housing market. But it also sparked a wave of speculation. Investors bought second and third homes. Institutional money moved into residential property. In many cities, prices outpaced income growth. Homes became less about shelter and more about investment. When rates began to rise again, affordability dropped. In some markets, activity stalled. In others, prices corrected. Stocks saw the same pattern. For over a decade, central banks kept rates low and sometimes used quantitative easing to inject even more liquidity into the system. That money flowed into markets. Companies with weak fundamentals but strong narratives attracted capital. Tech stocks soared. Startups raised money at inflated valuations. Retail investors, enabled by zero-commission trading and encouraged by rising prices, piled in. The market rewarded growth and momentum, not always profits or discipline. Low rates can also distort corporate behavior. When borrowing is cheap, companies are more likely to issue debt, not just to invest in growth, but to buy back their own stock. Buybacks reduce the number of shares on the market, which boosts earnings per share, even if actual profit hasn't changed. This can drive stock prices higher, benefiting executives with performance-linked pay. But it doesn't always improve the underlying business. It's financial engineering made more appealing by low rates. Private equity behaves differently when debt is cheap. Leveraged buyouts become easier to finance. Valuations climb as firms bid more aggressively for targets. The return calculations hinge on cheap borrowing. If rates rise later, the math no longer works. Refinancing becomes harder. Exit opportunities shrink. What once looked like a good deal turns into a problem. The strategy only works as long as rates stay low. Even venture capital is affected. Low rates reduce returns on traditional investments, making speculative tech plays more attractive. Money flows into startups chasing scale at any cost. Growth before profits becomes the mantra. Companies delay monetization. They burn cash. They focus on user acquisition. This approach can produce innovation, but it also fuels hype cycles. The result is a flood of capital chasing a few winners and many unproven ideas. When rates rise, that dynamic unwinds fast. Investors demand profitability. Startups cut spending. Valuations collapse. Low rates also influence investor psychology. They change what people consider risky. In a normal rate environment, a 5% bond looks appealing. In a low-rate world, 5% return requires much more risk. That shift isn't always obvious. Investors gradually move into high-yield debt, emerging markets, and speculative equities. Portfolio risk increases, but the perception of risk doesn't rise at the same pace. When volatility returns, the losses are larger than expected. People are surprised not because the assets were inherently risky, but because low rates mask that risk. Pension funds and insurance companies face their own challenges. These institutions rely on predictable returns to meet long-term obligations. When interest rates stay low for too long, their models break. They can't generate enough income from bonds. They're forced to chase. Insiders sit at the heart of a company. They know more than any outsider could. They see the operations, the real numbers, the internal discussions. They don't rely on quarterly filings or earnings calls. They live the business day to day. When they buy or sell stock, investors pay attention. The logic is straightforward. If the CEO or CFO is buying shares with their own money, it must be a good sign. They must believe the stock is undervalued. If they're selling, maybe trouble is coming. But the relationship isn't that simple. Insider trades can be noisy, inconsistent, and hard to read. That's the insider paradox. Insiders know the most, yet their trades don't consistently predict where the stock is going. In theory, insider buying should signal confidence. These are people who know the product pipeline, the contracts in negotiation, the hiring trends, the customer feedback. They should have the best information, and sometimes they do. If a cluster of senior executives buys heavily right before a strong earnings surprise, the stock may jump. But these moments are rare. Most insider activity is more mundane. A single director buys a modest amount. A VP sells shares they received as part of a compensation package. A CEO sells for estate planning. Each of these moves is legal, and each one muddies the waters. Insider selling, in particular, is difficult to interpret. People sell for many reasons. They may need to diversify. They may want to buy a home, pay taxes, or reduce concentration. Selling doesn't always mean they expect bad news. Sometimes it means nothing at all. A founder with 80% of their net worth in company stock will eventually need to sell, even if they believe in the business. If you read too much into that action, you may misjudge the situation. Buying can be just as ambiguous. Insiders may buy shares to send a message. They want to show confidence. They want to calm investors after a sell-off. But that doesn't mean the fundamentals are improving. They might believe in the long-term story while knowing short-term problems are unresolved. Their buying may reflect hope, not certainty. It may be symbolic, not predictive. There's also the issue of timing. Even when insiders are right about the direction of the business, the stock may not follow in the same time frame. A CFO may buy stock because they believe new product lines will boost revenue in 2 years. But if the market is focused on current earnings, the price may fall in the meantime. The insider was right in substance, but wrong in timing. For investors trying to profit from insider moves, that's a problem. The trade didn't work, even though the logic was sound. Regulations add another layer. Insiders can't buy or sell whenever they want. They're restricted by blackout periods and disclosure rules. They have to report trades through Form 4, which becomes public within days. That means by the time you see an insider's trade, it's already done. The price may have moved. The edge is gone. And because they're limited in how and when they can trade, insiders often act cautiously. They may not take full advantage of their insight. They may spread purchases over time or stick to small amounts to avoid drawing attention or triggering compliance flags. Academic research reflects this paradox. Studies show that insider buying has some predictive value, but it's modest. It works better when multiple insiders buy at once, especially after a price decline. Cluster buying can be a more reliable signal, but even then, it's not a guarantee. Insider trades improve odds. They don't offer certainty. As a signal, they're one of many alongside valuation, momentum, macro conditions, and market sentiment. Some investors try to build strategies around insider activity. They follow the filings. They look for patterns, but results are mixed. A strategy that buys after every insider purchase will underperform one that filters for size, frequency, and context. Buying $5,000 of stock isn't the same as buying $500,000. A CEO doubling their stake means more than a director making a token gesture. But it takes work to separate signal from noise. And even then, the future remains uncertain. There's also a psychological element. Investors love stories. An insider buying shares fits a simple story. They know more than me and they're buying. I should follow. It feels like getting a glimpse behind the curtain. But that simplicity can be misleading. The insider may be wrong. They may be overconfident. They may be misjudging how the market will respond. Knowing the business doesn't mean knowing the stock. Price reflects more than operations. It reflects expectations, perception, and positioning. During crises, insider behavior becomes even harder to read. In a downturn, insiders may buy to show faith or to stabilize a collapsing stock. Their motives can blur. Investors want to see confidence, but they also want honesty. A CEO who buys shares while cutting staff may appear strong or tone-deaf. The context matters. Insiders are not immune to bias. They believe in their company. That belief can cloud judgment. They may underestimate risks. They may overrate their prospects. Their trades reflect those biases. Just like any investor, they bring emotion to the table. They may feel pressure to support the stock. They may want to prove something to the market. These motivations aren't always rational. They're human. In some cases, insider trades are just part of a plan. Executives set up automatic selling programs known as 10b5-1 plans. These schedules execute trades at preset times, regardless of news or performance. The goal is to avoid the appearance of trading on non-public information. But to outside observers, it can be hard to tell the difference. A steady stream of sales may look like a red flag, even if it's just part of a plan set months ago. Ultimately, insider trades offer a sliver of insight, not a roadmap. They can confirm a thesis or add weight to a decision, but they shouldn't be used in isolation. The paradox is that the people with the most knowledge often trade for reasons that have little to do with that knowledge. They act with constraints, motives, and blind spots. And while their actions are worth noting, they aren't always worth copying. Decision. But they shouldn't be used in isolation. Efficiency means doing more with less. It means faster processes, leaner operations, tighter margins. From factories to financial markets, from global supply chains to data centers, modern systems are built to squeeze out waste. Every step, every resource, every delay optimized. The result is often higher profits, lower prices, and faster delivery. But there's a catch. The more efficient a system becomes, the less room it has for error. The buffer disappears. The slack is removed. There's no cushion. That's the efficiency versus stability paradox. In chasing maximum performance, we often remove the very things that help us survive disruption. This trade-off plays out clearly in supply chains. For decades, manufacturers embraced just-in-time, JIT, inventory systems. Instead of keeping large amounts of stock, they relied on precise timing. Parts arrived exactly when needed. Storage costs dropped. Working capital improved. It was a model of efficiency, but it also meant that any disruption, whether labor strikes, shipping delays, could shut the whole system down. There was no extra inventory to fall back on. During the COVID-19 pandemic, the risks became visible. Factories halted because a single component was stuck at a port. Supermarkets ran out of staples. Car companies paused production due to chip shortages. The system was optimized for speed, not for shocks. The financial world offers another example. In the quest for faster execution and tighter spreads, markets embraced high-frequency trading and algorithmic strategies. These systems route trades in milliseconds. They lower costs and improve liquidity under normal conditions. But in times of stress, they can magnify volatility. When prices start moving fast, algorithms respond faster. They withdraw liquidity, chase momentum, or trigger feedback loops. The 2010 flash crash exposed this fragility. Stocks plunged and recovered within minutes, with no underlying reason. The system worked perfectly until it didn't. Banks followed a similar path. In the years before the 2008 financial crisis, financial institutions streamlined operations, increased leverage, and expanded credit. Risk was sliced up, repackaged, and sold. Mortgage-backed securities promised safety and return. Capital requirements were optimized to the letter, but the structure was brittle. It depended on housing prices rising forever and borrowers never defaulting all at once. When reality shifted, the entire system cracked. The banks had been efficient but not resilient. This pattern holds in energy systems. A power grid optimized for cost savings may not have enough redundancy. Every transmission line, every generator, every control center runs close to full capacity. That keeps prices low and utilization high. But it leaves little margin for error. A heat wave, a cyber attack, or a mechanical failure can lead to cascading outages. The Texas power crisis in February 2021 showed what happens when an efficient grid isn't prepared for rare but severe conditions. Blackouts spread across the state. Water systems failed. The grid had no backup because backups are inefficient by design. The paradox also shows up in organizations. Lean companies reduce headcount, flatten structures, and cut spending. They're agile, profitable, but they rely on everyone doing their job perfectly. When a key person quits or gets sick, things slow down. Institutional memory disappears. Projects stall. A team built for efficiency can't easily absorb surprise. In contrast, a company with some redundancy, overlapping roles, slack time, cross-training, might appear bloated in calm times but proves more stable during disruption. Airlines operate at the edge of this paradox. They use algorithms to maximize seat utilization. Planes run full. Staff are scheduled to the minute. Everything is designed to reduce cost per mile. But when a snowstorm hits or a computer system fails, the delays ripple through the entire network. There are no spare crews, no extra planes. One missed connection leads to dozens of cancellations. Passengers feel the downside of hyper-efficiency. What saves money day to day causes chaos when conditions shift. Even in agriculture, the trend toward monoculture, planting a single crop over vast areas, is driven by efficiency. It simplifies planting, harvesting, and pest control. It boosts short-term yields, but it weakens the system. A single disease, a drought, or a supply shock can wipe out entire harvests. Diversity, which is less efficient, provides resilience. It spreads risk, but it costs more and is harder to manage. Software development and digital infrastructure follow similar lines. Engineers streamline code, remove redundancies, and rely on centralized services. This lowers hosting costs and improves performance. But it also introduces single points of failure. If one cloud provider goes down, thousands of services can fail. If a dependency is compromised, the damage spreads fast. Efficient systems often lack the independence to isolate and contain problems. Part of the issue is that fragility hides in success. When things are going well, efficient systems look invincible. They produce more with less. They cut costs. They outperform. And because they perform so well during normal times, it's easy to assume they'll hold up under stress. But stress doesn't show up in a spreadsheet. It shows up in extreme events, low probability, high-impact disruptions, the very ones we tend to dismiss as rare. In nature, stability often comes from what looks like waste. A tree drops thousands of seeds knowing most won't survive. A body stores fat not because it's efficient, but because it needs energy reserves in lean times. Ecosystems maintain diversity not because it's the most productive, but because it's the most adaptable. These traits aren't lean, but they last. Natural systems sacrifice short-term efficiency for long-term resilience. That's the lesson modern systems often forget. The pursuit of efficiency can strip away the slack that absorbs shocks. It removes the margins that catch mistakes. It pushes operations to the edge, where the smallest error triggers failure. In doing so, it increases the stakes of normal fluctuations. What used to be manageable becomes a crisis. Safe assets are the bedrock of finance. They protect capital. They anchor portfolios. They offer reliability in a world full of risk. Treasury bonds, high-grade government debt, certain types of cash equivalents, these instruments are considered nearly immune to default. In crisis, investors run to them. In uncertainty, they serve as a store of value. They don't offer high returns. That's not their job. They offer safety. But when everyone runs to the same so-called safe asset, something happens. Prices rise. Yields fall. Liquidity dries up in the wrong places. Distortions build. A market designed to offer stability becomes the epicenter of crowding, fragility, and, in extreme cases, failure. This is the safe asset paradox. The more people believe in the safety of an asset and crowd into it, the less safe that asset becomes. The paradox begins with demand. In uncertain environments, capital floods toward perceived safety. U.S. Treasuries are the prime example. During global stress, wars, recessions, pandemics, investors buy treasuries not for return but for survival. That demand pushes prices up and yields down. In the short term, that's fine. But over time, when everyone does the same thing, the safety net gets stretched thin. At extremely low yields, treasuries stop acting like a source of income and start acting more like cash with duration risk. Investors still hold them because they think they're safe. But they now face new dangers like inflation eroding real returns or interest rate shifts triggering price declines. The asset still seems safe, but its behavior has changed. And most investors don't adjust. They keep treating it like a no-risk option. The 2020 to 2021 bond rally is a good example. Central banks slashed interest rates to support the global economy. Investors rushed into government bonds. Yields on some 10-year sovereign debts dropped near or even below zero. At those levels, the upside was gone. Bonds offered no cushion. Yet investors continued to pile in, not because the assets were attractive, but because they were safe. When inflation returned in 2022 and rates rose quickly, those same bonds lost value fast. The safety they promised vanished. People who thought they held low-risk investments watched their portfolios take unexpected hits. Liquidity is another issue. Safe assets are assumed to be easily tradable. They're the assets you can sell quickly when you need cash. But that assumption breaks down when everyone wants to sell at once. During the 2008 financial crisis, parts of the mortgage-backed securities market, previously rated as ultra-safe, froze. Investors realized too late that their safe assets were only safe when no one else needed to sell. The market couldn't absorb the volume. Buyers vanished. Prices fell off a cliff. The paradox isn't limited to bonds. Money market funds are also seen as safe. They aim to keep a stable value, typically $1 per share, and invest in short-term, high-quality debt. But even these instruments have broken under pressure. In 2008, the Reserve Primary Fund broke the buck after exposure to Lehman Brothers. That triggered a run. Investors panicked. Regulators stepped in. It was a rare event, but it exposed the fragility hidden in crowd behavior. When everyone believes they can exit safely, no one is prepared for the moment they can't. Even in equities, the same dynamic plays out. Certain large-cap stocks, mega-cap tech, consumer staples, or defensive sectors are seen as safe havens. They have strong balance sheets, stable earnings, global reach. Investors buy them during uncertainty. As the crowd piles in, prices rise. The stocks become more expensive. The perceived safety gets priced in. At a certain point, valuation risk becomes the new danger. A safe stock trading at 40 times earnings isn't safe anymore. It's fragile, because any disappointment leads to a sharp drop. It's not the business that's risky. It's the expectation baked into the price. Gold offers another angle. It's considered a hedge against currency collapse, inflation, and political instability. In times of fear, investors turn to it. But gold doesn't generate income. It just sits. Its price is driven entirely by belief that others will also see it as a store of value. When that belief becomes consensus, the trade gets crowded. And when something changes, interest rates rise, inflation cools, or the dollar strengthens, those who ran to gold often rush back out. The asset didn't become less stable. The crowd just changed direction. The safe asset paradox becomes more dangerous when institutions are involved. Banks, insurance companies, pension funds all hold large amounts of safe assets. They use them to match liabilities, satisfy capital requirements, and manage liquidity. When these assets perform as expected, the system works. But when crowding leads to overexposure, or when correlations shift, the safety can disappear. In early 2023, Silicon Valley Bank failed, in part due to large holdings in long-dated treasuries and mortgage securities. These were seen as safe, but when rates rose, their value fell. SVB had to sell at a loss. That loss triggered deposit outflows. The assets weren't bad. They were misaligned with the bank's liquidity needs. The assumption that safe assets could cover obligations failed under stress. Crowding also distorts policymaking. When everyone wants to hold the same safe asset, governments and central banks may feel pressured to meet that demand. They may expand issuance, adjust regulations, or intervene in markets. This creates moral hazard. It encourages the belief that safety will always be guaranteed. That belief reinforces crowd behavior. It builds systemic risk. The paradox deepens because investors rarely question the herd. Safety feels strongest when everyone agrees. When a consensus builds around an asset class being low risk, saving is good. That's what most people are taught. It shows discipline. It builds security, prepares for emergencies. Households that save can invest, handle shocks, and plan for the future. On an individual level, saving is a wise financial move. But if everyone saves at the same time, especially during a downturn, it can damage the entire economy. That's the saving paradox, also known as the paradox of thrift. What's good for one person becomes harmful when everyone does it at once. The logic behind saving is simple. You earn money, spend some, and put the rest aside. That saving can be used later for consumption, investment, or retirement. But your spending today is someone else's income. If you go out less, buy fewer goods, delay repairs, or skip upgrades, the businesses you would have paid earn less. Their employees see fewer hours. Their suppliers sell fewer materials. The money you keep in the bank is money that doesn't circulate. Multiply that behavior across millions of households, and the economy starts to slow. In a recession, people naturally become cautious. Job losses rise, incomes shrink, uncertainty grows, so people respond logically. They cut back on spending and increase savings. They prepare for the worst. This makes perfect sense for each household. But when everyone cuts back at once, total demand across the economy drops. Businesses see falling sales. They reduce staff or close entirely. Unemployment rises further. Fear increases, and the cycle deepens. The effort to protect individual finances ends up hurting the collective economy. This feedback loop is what turns a downturn into a prolonged slump. The original shock, whatever caused the recession, is made worse by a collapse in demand. The economy contracts not just because of the initial hit, but because consumers retreat. Even people who still have jobs and income pull back. They don't know what's coming, so they save more. And that drop in spending ripples through every industry. Consider a basic example. A small town experiences a factory closure. Hundreds of workers lose their jobs. Families in the area start saving aggressively. They stop eating out. They delay car repairs. They skip vacations. The local restaurants, garages, and hotels see revenue fall. To cope, they lay off staff. More people lose income. Those people, in turn, spend even less. Now the slowdown isn't just about the factory. It's about the entire community reacting by saving more and spending less. The original problem spreads. Fear fuels contraction. The paradox is that these choices, made with good intent, make things worse. If one family saves 20% of its income during a crisis, it may weather the storm better. If every family does the same, the storm intensifies. Income across the economy shrinks. The pool of money available for wages, services, and investment dries up. Even though households are saving more, their income is falling faster. In aggregate, total savings may not increase at all because the pie is shrinking. People are trying to protect themselves, but the collective outcome is a slower, weaker economy. This problem is unique to downturns. In a growing economy, saving doesn't have the same effect. One person's saving can be offset by another's investment. Banks lend savings to businesses. Spending keeps moving. But during a recession, borrowing and investment also fall. Businesses don't want to expand. Consumers don't want to take on debt. Even if savings are available, no one wants to use them. The system stalls. Keynesian economics highlights this problem. John Maynard Keynes pointed out that total demand drives output and employment. When private demand falls, government spending should rise to fill the gap. That's the argument for stimulus. Public investment keeps money moving when households and businesses pull back. It gives people income so they can spend again. Without that intervention, the economy risks falling into a self-reinforcing decline. During the Great Depression, this paradox played out clearly. People hoarded money, banks failed, confidence vanished. The result was a collapse in demand that lasted years. Franklin Roosevelt's New Deal programs were partly an effort to counteract the saving paradox. The government stepped in as a spender of last resort. Public works, Social Security, and labor programs injected money back into the economy. More recently, the 2008 financial crisis followed a similar pattern. After the housing bubble burst, households pulled back sharply. Many were over-leveraged. Others were simply afraid. Spending dropped across the board. Businesses laid off workers. Investment froze. The Federal Reserve slashed interest rates, but fear remained high. It took years for demand to recover. Even as savings rates rose, the economy stayed weak because there wasn't enough spending to support full employment. The COVID-19 recession added a new layer. Lockdowns forced people to stop spending. Households saved by default. But the result was the same. Businesses lost revenue. Workers were laid off. Total demand collapsed. This time, governments responded quickly with large stimulus checks, unemployment support, and emergency lending. These measures were designed to break the cycle, to give people money so they could keep spending even while saving. It worked better than in 2008, but the underlying paradox remained. The saving paradox is a reminder that the economy is a system of relationships. Your spending supports someone else's job. Their spending supports yours. When everyone acts in their own best interest, the group outcome can suffer. This is true in other areas as well. If everyone tries to sell a stock at once, the price crashes. If everyone tries to withdraw from a bank, the bank fails. In those cases, individual rationality creates collective instability. Solving the saving paradox isn't about telling people to stop saving. Households need security, but it does mean recognizing that saving alone isn't enough to restore growth during a recession. If everyone cuts spending at once, the economy doesn't recover, it contracts. The solution lies in policies that support demand, fiscal stimulus, job guarantees, infrastructure projects, and safety nets that encourage confidence. When people feel secure, they're more willing to spend. When spending returns, so does growth. This paradox also challenges certain cultural values. In many societies, thrift is a virtue. People are praised for being frugal, for living below their means, for saving for a rainy day. And individually, those are good habits. But in the aggregate, they can slow recovery. The economy doesn't just need savers. It needs spenders. Not reckless consumers, but people willing to buy goods, hire services, and invest in their lives. That activity creates jobs. High yield looks attractive. You open a chart and see one bond paying 3%, another paying 9%. One stock yields 2%, another boasts 11%. If you're building an income portfolio, the math seems easy. Why settle for less when you can earn more? That's how it starts. Investors see high yield and assume it means better cash flow, more passive income, and faster compounding. But high yield is rarely free. Often, it comes with hidden risks: credit deterioration, falling asset prices, dividend cuts, or poor fundamentals. Over time, these risks tend to show up not as smaller gains, but as outright capital losses. That's the high-yield paradox. The very assets promising high income often destroy the value needed to make that income matter. Start with high-yield bonds. Also known as junk bonds, these are corporate bonds rated below investment grade. Companies that issue them tend to have higher debt loads, weaker cash flow, or more unstable business models. The bonds pay more because investors demand compensation for taking that credit risk. If the company stays afloat and makes all its payments, the investor gets a high yield. But that "if" is where the trouble starts. When economic conditions shift, when growth slows, interest rates rise, or the company's earnings disappoint, default risk increases. Bond prices fall. The income may still be coming in for now, but the value of the bond drops on the open market. If the company misses a payment or restructures its debt, the bondholder could lose a big chunk of principal. Imagine buying a bond yielding 10%. You're earning more than triple what a treasury bond pays. But a year later, the bond's price drops by 20% because the market thinks the issuer may not survive the next downturn. That 10% income gets wiped out by a much bigger capital loss. If the company defaults entirely, you could lose most of your investment. The yield never compensated for the real risk. This dynamic plays out in equities too. A company offering a double-digit dividend yield should immediately raise questions. Why is the yield so high? In most cases, it's because the stock price has fallen. Dividends are calculated as a percentage of share price. If the stock trades at $100 and pays a $5 dividend, the yield is 5%. If the stock drops to $50 and keeps paying $5, the yield jumps to 10%. That doesn't mean the company suddenly became more generous. It usually means investors have sold the stock, possibly because they expect the dividend to be cut or the business to deteriorate. Chasing high dividend yields without understanding the business behind them is one of the most common mistakes income investors make. Take the example of a struggling telecommunications company that pays a 12% dividend. On paper, that's appealing. But if revenue is declining, debt is rising, and capital expenditures are eating into free cash flow, that dividend may not last. At some point, the company will need to reduce it. When the cut comes, the stock drops again because income-focused investors flee. You didn't just lose part of your income, you lost capital. You would have been better off with a 3% yield from a company with stable cash flow and a strong balance sheet. This isn't theory, it happens often. Energy companies during the oil downturn, REITs in periods of falling occupancy, financial firms with excessive leverage. What they have in common is that their high yields attract attention, but the risks behind the yield get ignored until it's too late. In many cases, the dividend was unsustainable from the start. The company paid it to signal strength or to keep up appearances. But when business conditions worsened, the illusion cracked. Investors learned that income isn't income if it comes at the cost of capital erosion. Closed-end funds and structured income products also fall into this trap. These vehicles often promise yields of 8%, 10%, or more. They use leverage, derivatives, or aggressive payout policies to generate those returns. But they don't always generate enough income to cover those payouts. Instead, they return capital to investors while calling it distribution. Your account may show a steady stream of cash, but your investment is shrinking. Over time, you realize you were just getting your own money back minus fees under the label of high yield. This paradox becomes even more dangerous in low-rate environments. When interest rates are low, investors stretch for yield. They buy lower-quality bonds. They load up on dividend stocks without looking at fundamentals. They invest in exotic credit instruments they don't fully understand. The demand for yield pushes prices up and yields down until a shock exposes the risks. Then capital flees, prices collapse, yields spike, but only because nobody wants to buy anymore. The assets become toxic, not rewarding. Preferred stocks and MLPs, master limited partnerships, also illustrate this paradox. Both can offer attractive yields, but both carry risks that traditional investors often overlook. Preferred stocks may have fixed dividends, but they behave more like bonds than common equity. When rates rise, their prices fall. MLPs are sensitive to energy markets and regulation. When oil prices collapse or tax rules change, these income vehicles suffer large drawdowns. The yield looked stable until the environment shifted. One of the biggest traps in the high-yield space is the illusion of control. Investors tell themselves they'll sell before things get bad. They'll monitor the company. They'll watch for signs. But deterioration happens gradually, then suddenly. A bond that trades at 98 today might fall to 90 next week and 75 the week after that. A dividend stock might cut its payout overnight. By the time the red flags are obvious, the market has already priced in the bad news. Getting out without loss is harder than it seems. This doesn't mean all high yield is bad. Some companies can sustain high payouts. Some bonds offer good risk-adjusted returns. But the burden is on the investor to understand what's behind the yield. When a system breaks, someone has to step in. In a financial crisis, central banks and governments often act as backstops. They inject liquidity. They guarantee deposits. They bail out institutions. The goal is to stop panic, preserve confidence, and prevent collapse. Without that intervention, fear spreads. Markets freeze. A bad situation gets worse. Bailouts restore order. They protect jobs, savings, and entire economies. But they also send a message. If you're big enough, important enough, or connected enough, you won't be allowed to fail. That's the moral hazard paradox. The very safety nets that prevent disaster can also reward and even invite risky behavior. Moral hazard arises when people take on risk knowing they won't bear the full consequences of failure. If someone else absorbs the loss, the incentive to act prudently weakens. In finance, this becomes a serious problem. Banks, insurers, and investors operate in a world full of uncertainty. If they believe losses will be socialized while gains remain private, they're more likely to overextend. They issue risky loans. They invest in complex, high-yield products. They stretch leverage. The system becomes more fragile, ironically, because the safety mechanisms are so reliable. The 2008 financial crisis made this paradox visible. Big banks packaged risky mortgages into securities and sold them with high credit ratings. They made billions. When the housing market collapsed, those assets turned toxic. The losses spread quickly through the global financial system. Panic set in. Credit markets locked. The US government responded with massive bailouts, capital injections into major banks, guarantees for money market funds, and an unprecedented $700 billion Troubled Asset Relief Program, TARP. These steps stabilized the system, but they also told Wall Street something else. If the stakes are high enough, the state will step in. Some banks went under, others took losses, but many senior executives kept their jobs. Some firms even paid bonuses after receiving public funds. For ordinary citizens, the message was bitter. The same institutions that caused the collapse were rescued with taxpayer money. Homeowners, on the other hand, faced foreclosure. Job losses mounted. Retirement savings vanished. The public bore the brunt. This imbalance deepened distrust and fed the sense that some actors could gamble without consequence. Since then, regulators have tried to reduce systemic risk. Capital requirements increased. Stress tests became routine. Resolution regimes were built so that even large institutions could fail in an orderly way. But the perception hasn't fully changed. When big banks get into trouble, the market still assumes they'll be rescued. That assumption affects behavior. Risk models bend. Lending standards loosen. Safety nets create a false sense of security, and the cycle begins again. Central banks face their own version of the paradox. In recent decades, especially since 2008, they've acted not just as lenders of last resort, but as buyers of last resort. They purchase government bonds, mortgage-backed securities, even corporate debt. This support stabilizes prices. It reassures markets, but it also distorts incentives. Investors expect intervention. Asset prices reflect that expectation. The result is financial markets that depend on policy, not just fundamentals. This dynamic showed up again during the COVID-19 shock. In March 2020, markets collapsed. Liquidity vanished. The Federal Reserve intervened forcefully. It slashed rates, launched unlimited quantitative easing, and backed credit markets with lending programs. These actions were necessary. Without them, the economy could have imploded. But they also signaled that whenever markets fall fast enough, help will come. That knowledge shapes risk appetite. Traders position for support. Volatility becomes an opportunity, not a threat. Insurance systems reflect the same tension. A company that knows it's insured against loss may take less care to avoid that loss. In banking, deposit insurance prevents runs, but it can also encourage aggressive lending. If customers know their money is protected, they won't care how risky the bank's behavior becomes. That's why regulators impose strict rules on insured institutions. Without limits, insurance can breed the very failures it's meant to prevent. Corporate bailouts raise a different kind of moral hazard. When governments rescue large employers, airlines, automakers, or utility providers, they often justify it by pointing to jobs, infrastructure, or national security. These are valid concerns. But each bailout teaches executives that failure won't be final. They can prioritize shareholders, ignore structural problems, and expect support in bad times. This weakens discipline. Capital gets misallocated. Weaker firms survive not because they're competitive, but because they're protected. The paradox also affects public policy. Politicians want to prevent suffering, but short-term relief can delay necessary reform. If a failing system gets propped up again and again, it never adapts. It becomes dependent. In the long run, that's more dangerous than failure. Markets work best when they reward prudence and punish recklessness. But when losses are absorbed by the public, that discipline fades. Not all bailouts are created equal. Some include strict conditions: equity stakes for the government, leadership changes, limits on dividends and bonuses. These steps can reduce moral hazard. They signal that help comes at a cost. But even then, the precedent is set. Once an institution is saved, others take note. They calibrate their behavior accordingly. The knowledge of past rescues becomes part of future decision-making. There's a deeper problem too. Systemic risk is hard to see in real time. When times are good, excessive risk doesn't look dangerous.
You walk into a room. In front of you sit two boxes. One is transparent. You can see that it contains $1,000. The other is opaque. You don't know what's inside. It could be empty, or it could contain $1 million. You're told you can either take both boxes or take only the opaque one. But there's a catch. A highly reliable predictor has already made a decision about you. If the predictor believed you would take only the opaque box, they put $1 million in it. If they believed you would take both boxes, they left the opaque box empty. The predictor made their decision yesterday. The boxes are sealed now. Your choice won't change anything physically inside them, but it will determine how much money you walk away with. This is Newcomb's paradox. It's not just about a gambling setup. It tests how we understand decision-making, free will, prediction, and causality. The scenario forces you to pick between two seemingly logical strategies. One says take both boxes. The other says take just one. Each has strong reasoning behind it. That's what makes it a paradox. The first strategy is the one that uses dominance reasoning. This view says no matter what's in the opaque box, you're always better off taking both. If the opaque box is empty, you get $1,000 instead of nothing. If it has $1 million, you get $1,001,000 instead of just the million. The $1,000 in the clear box is guaranteed. It's sitting there. Why walk away from it? This reasoning treats the contents of the boxes as fixed. The predictor already made their choice. You can't change it now. You can only choose what to do with what's there. But the second strategy uses what's called evidential or expected value reasoning. This view says you should take only the opaque box, because the predictor is almost always right. If you take only the opaque box, that's strong evidence that the predictor predicted this and filled it with $1 million. People who take one box tend to walk away much richer. People who take both often find the opaque box is empty. If the predictor has a near-perfect track record, then your choice gives you information about what's likely to be inside. Not because it changes the past, but because it reflects it. Your choice is linked to what the predictor saw in you. That's where the paradox hits. One line of thought says you should take both, because the past is fixed and more money is better. The other says you should take only one, because the predictor's accuracy makes your choice a kind of self-fulfilling prophecy. Both arguments feel right, but they lead to opposite decisions. To understand why this matters, you have to think about prediction and free will. If the predictor is truly accurate, then your choice was known before you made it. That threatens the idea that your decision is free. But if your decision is free, then how can the predictor know what you'll do? The paradox forces you to ask whether your current action can be logically tied to a past event. Not causally, you're not changing the past, but statistically. The predictor isn't magical. They don't control the boxes. They just predicted you. Their power comes from knowing how you think. Imagine they've watched millions of people face this choice. They have access to your behavior, your history, even your brain scan. They see how people like you tend to decide. And they're rarely wrong. That creates a new kind of loop. Your choice reflects their prediction, and their prediction shapes what's in the box. Even though the box was sealed yesterday, your decision today is bound to it. Think of it like a mirror. You can't change the image in the mirror by acting now, but the image still matches what you do. It's not magic, it's symmetry. The predictor doesn't cause your action, but their prediction mirrors it with precision. Your behavior was the pattern they read, so when you choose, you reveal whether you were predicted as a one-boxer or a two-boxer. The boxes respond accordingly. This breaks how we usually think about decisions. Normally, we imagine cause and effect flowing forward. You act, and then something happens. But Newcomb's paradox makes the past and the future feel entangled. It asks if it makes sense to act as if your decision tells you something about what's already happened. It gets more interesting when you add realism. Say the predictor is just 90% accurate. That changes the math. Now, you don't get certainty, you get probability. If you one box, there's a 90% chance you get $1 million and a 10% chance you get nothing. If you two box, you always get $1,000 and a 10% chance at $1 million. Expected value favors one boxing, $900,000 versus about $101,000. The better the predictor, the more one boxing pays off. But if the predictor is only 60% accurate, the expected value shifts toward two boxing. So Newcomb's paradox also asks, how much trust do you place in predictions? Do you base your decision on expected outcomes, or do you reject the link between your action and the predictor's past behavior? This split mirrors two schools of thought in decision theory: causal decision theory and evidential decision theory. Causal decision theory says you should choose the action that leads to the best outcome based on how your action causes things to happen. It supports taking both boxes. The boxes are already filled. You cause nothing by choosing. Just take what's there. Evidential decision theory says you should choose the action that is evidence of the best outcome. Since the predictor is accurate, choosing one box is evidence that the million is in there. Taking one box increases your expected gain, even if it doesn't cause the money to appear. Both theories are internally consistent, but they lead to different actions. That's why Newcomb's paradox hasn't been resolved. It touches on what kind of reasoning we accept. It also reflects how we think about responsibility, identity, and control. Now consider someone who runs the game every day. They've seen hundreds of people walk away with $1 million after one boxing. They've seen two boxers get $1,000 over and over. They believe the predictor works. What would they do? They would probably one box. Not because it makes rational sense in a vacuum, but because the pattern supports it. It's like choosing a lottery ticket that always wins. Even if the logic feels strange, the results guide behavior. That's why Newcomb's paradox endures. It exposes a fracture between logic and evidence, between agency and prediction. It shows how hard it is to define rational choice when the future and past seem to reflect each other. It asks whether our decisions are more than isolated actions, whether they're woven into the fabric of time, prediction, and trust.